Well, good morning or good afternoon, even to some people. Welcome to the 6th annual charity conference from the Edge. And I think that, first of all, we've got to remember that, it is a charitable conference. We've had a fantastic response this year. We've raised, we reached our target of 15,000 and just gone over it. So super thank you to everyone who donated. Very proud of that. And also, like I say, the first and foremost is raising money for the charity. Despite what people think, it's not about us. It's not about the speakers. That's why we do it. And it's obviously a terrible disease. Affects 1 in 10 over 65. And it's important to remember that before we start. So today I want to show a little video beforehand, as per normal for our regular guests to remember, just to remind you of why we do this and the importance of making awareness out there. So I'll do that in a second. But as regards to the speakers today, we've always prided ourselves on getting speakers who are a little bit different. And in this world today, it needs a lot more than valuation to really move stocks. And it's a combination of valuation, it's a combination of edge, it's a combination of analytical edge, behavioral edge. And we've got some of those people today. And I'm really, really excited about the lineup today. So what we're going to do, we're going to show a little video, then I'm going to introduce the first guest, and we're going to get going.
What is Alzheimer's disease? Alzheimer's is a slow, fatal disease of the brain affecting 1 in 10 people over the age of 65. No. Process. When that happens, it gets tougher and tougher to find the right word. Next, the disease creeps toward the front of the brain, where logical thought takes place. Very gradually, a person begins to lose the ability to solve problems, grasp concepts, and make plans. Next, the plaques and tangles invade the part of the brain where emotions are regulated. When this happens, the patient gradually loses control over moods and feelings. After that, the disease moves to where the brain makes sense of things it sees, hears, and smells. In this stage, Alzheimer's wreaks havoc on a person's senses and can spark hallucinations. Eventually, the plaques and tangles erase a person's oldest and most precious memories, which are stored here in the back of the brain. Near the end, the disease compromises a person's balance and coordination. And in the very last stage, it destroys the part of the brain that regulates breathing and the heart. The progression from mild forgetting to death is slow and steady and takes place over an average of 8 to 10 years. It is relentless and, for now, incurable. Helping your family, friends, and neighbors to better understand Alzheimer's will reduce stigma, improve care, and even help fight for a cure. Thanks for helping to do your part. Learn more at www.aboutalz.org.
Okay, so sorry about the sound on the first bit there. That was my fault. But yeah, that's the disease in a nutshell, and it's all obviously terrible thing. And you know, the more I talk to people, the more people have been in touch with it in some way. So super proud of everyone today with the donations, and you know, we're going to push on right now. So our first guest is pretty much a mainstay. He's been there from day one. And Paul Johnson has always been a favorite of the conference, really. His insights are absolutely invaluable. Always get great feedback from the audience of him. He's super at what he does. He's author of this book, Pitch the Perfect Investment. Go buy it. He'll tell you that himself. He doesn't need me. But what a great read that is in terms of his insights into the world and how things work. So I'm not going to say any more, but I'm going to hand over to Paul and enjoy Paul. We'll have a little 5-10 minute Q&A afterwards. So if you have any questions, put them up in the bar at the side, and we'll endeavour to answer those. Thank you, Paul.
Jim, thank you for the nice introduction. Am I driving slides, or you guys driving slides?
I think
It says I have them, but it says I'm disabled.
Oh, let's have a look here.
Happy to drive, but
yeah. How about now?
Perfect.
Look at that. Absolute power you have.
All right, excellent. All right, let me put this in slide mode. Yeah, this is let's let me just get everything. All right. It's always great fun to come to the Edge event in November. I look forward to it. I think this is my 6th conference involved, and I always commit to Jim that I'll do something new that I've never done before. And today, I think I'll deliver on that. It just is a very, very brief outline. I'm going to start out, you can call it either theoretical or academic at the beginning, but I'm going to end very pragmatically. So if you would indulge me a few minutes right at the beginning as I kind of set everything up, but I'm going to leave you with some tools on how you can think about growth and the valuation of growth. I would say that we certainly have learned a lot about lots of valuation methods and importance, but the big bugaboo, and I'll make this argument during the presentation, but the big bugaboo is always how do you value growth? And I put together some work that I delighted to share, frankly, other than the classroom at Columbia over the last couple of months. I haven't shared this with anybody. So these are all brand new slides that I've been working on. I'm pretty excited about. All right, so let's start. All right, so this is the quote sort of academic part, and I do appreciate just a little patience, a little leeway as we get through it. I know some of you are probably not necessarily want to go back to the classroom first thing on a Thursday morning, but we do know, I mean, this is just simple stuff from first principles. We do know that the value of an asset, the fundamental value of an asset, certainly over time is driven by cash flow, uncertainty of those cash flows, and then the timing of those cash flows, the time value of the money. We know this to be true. And then cash flow is made up of 4 components: the timing of the cash flow, the duration that you're going to get the cash flows, the magnitude of the cash flows, and then any growth. In reality, the only thing we really care about, because we tend to, in finance and when we look at companies, we tend to assume annual cash flows, so we can take that assumption away. What we really care about is the duration, magnitude, and growth of the cash flows, and then we discount it back for uncertainty and the time value of money. I'm going to focus on sort of the right side of this chart, duration, magnitude, and growth, in my lecture today. All right. We also know that the fundamental value of a company can be modeled as a DCF. where we take essentially the present value of all future cash flows and we discount them back for time and the uncertainty around those cash flows. Now, the problem with the DCF, any of you that have worked with it, is that we have one equation and three unknowns. And anybody with some quantitative skill knows that we can't solve for all three unknowns with the single equation. So we've been trying to figure out how we can make a DCF more pragmatic and more insightful. And that's what I want to show you is some of the ways we've pushed it. All right. So here's the DCF challenge. We have these annual NOPAT cash flows going out, in this case, 5 years. In reality, they have to go out forever, but valuing this stream of cash flows is really the task. That's what we're trying to do, but using a classic DCF.
Oh, sorry to interrupt. I don't think we're seeing your slides, buddy. I think we're just seeing the first slide. Are your slides scrolling?
I have been scrolling the whole time. Let's just start again.
Okay.
Let's see if this does it better.
Oh, there you go. You started screen sharing. There we go.
All right. I apologize. Let me start back at this for a moment. Can you see this now?
Yeah, just scroll once for me. There we go.
All right, and you've not seen this yet, right?
No, sir, no.
Okay, so I'll do the quick version just so we can do it. So if you look at this chart, the value of the asset are these, the future cash flows discounted back for uncertainty and the time value of money. And then cash flows, of course, have four primary components: the timing of the cash flow, duration of the cash flow, magnitude, and growth. What we really want to focus on, what really matters is really the three primary drivers: the duration of the cash flows, how long they'll last; the magnitude of the cash flows, how big they'll be; and then growth, if there's any growth. And then we discount it back for the uncertainty and then the time value of money. We can model this as a DCF. The challenges of DCF, of course, is that we have a single equation and three unknowns, and you can't solve the equation. As a consequence, you have to make some assumptions. So what I'm trying to do is make the DCF a more practical tool. And this is sort of the academic part, but I promise we'll get to very, very hands-on practical tools. So here's sort of the challenge. You've got I just modeled 5 years. You could go out many more. You're trying to model these 5 years of cash flow. And the challenge, what we've done historically for most people, is they use some sort of forecast period, referred to as the explicit forecast period, maybe 5 years, maybe 7 years. Some people will go out 10 years. But the rest of the cash flows are all tied up in the terminal value, all of the years after the explicit forecast period. And then it just doesn't work. And I think most people in the business kind of given up on using a DCF in anything other than just sort of helping to model it because of the assumptions. And this is really the challenge. But if we split the DCF challenge into two components, one which we'll call a steady state level of cash flows, and the other the growth in those cash flows, or NOPAT, and we can now, once we split the problem, we can attack the problem as two separate problems. One is the steady state growth, steady state cash flows year in and year out, and then the growth in the NOPAT. Now, modeling this is trivial. Modeling a steady state growth, a steady state no growth cash flows is actually fairly trivial. Modeling growth is hard, but if we separate them out, we can do the easy part and then focus on the hard part. Now, the assumption I'm going to make is that there's no growth. So I'm going to assume that the cash flows in year one are equal to the cash flows in year two, equal to the cash flows in year three, equal to the cash flows all the way out to infinity. Now, a lot of pushback, people say, well, there's no way I can assume that those NOPAT are going to last forever. And I understand that. It's a fair comment. But do keep in mind that every valuation method assumes a steady state growth, a steady state level of cash flows in it. If you look at EBITDA multiples, you're sort of in banking or private equity, that assumes by definition that the cash flows will last forever. If you're looking at PEs, that assumes the cash flow will last forever. Any kind of valuation method you're using based on cash flows assumes that there's a steady state. So this is no more of assumption than we currently use. It's just being very explicit in the assumption, whereas those other valuation methods just hide it in the overall. All right, so if we assume these NOPATs are going to be the same every year, no growth, then the value of stock is trivial. We can use a perpetuity valuation formula. So we call that earnings power value. So earnings power value is an annual NOPAT divided by capitalized by some discount rate. And it's simple. That is your steady state, no growth value. This is actually kind of a cool insight. If we've come up with a NOPAT that we think is the steady state NOPAT for the company, we can create earnings power value. That's the value of the business without growth. So that's sort of our first stop. And as I said a few slides ago, valuing cash flows that aren't growing is trivial, as you can see. And if you use a discount rate of, say, 10%, it's even easier because you're just a 10 times multiple. In fact, that is a 10 times PE is an easy way to think about it. That's the value of the company without growth. Now we have to go attack growth. That's going to be the tricky part. All right, so this is where we start. Enterprise value. That's the market value of equity plus the market value of debt. Often we have to use book value because the debt doesn't trade, minus any excess cash plus some other stuff. I've simplified this. But effectively, enterprise value is the present value of all future cash flows. That's what it is. And you can actually think of it this way. Enterprise value is the consensus estimate of the present value of future cash flows. So it's really important to realize, because this is enterprise value essentially represent investor expectations on the future of all cash flows. Okay, great. That's our first component. Second one is earnings power value. And we just defined earnings power value is some steady state NOPAT divided by a discount rate. That should be an R. I doesn't matter. All right, that's your steady state no growth value. No growth being the key. So if I just do a little simple math, I take your enterprise value, which is the value of all cash flows, and I subtract off earnings power value, which is the steady state, no growth value, right? Value of all cash flow, steady state, no growth value. What do I get? I get the market implied value of growth, which is in fact the title of this talk. Okay, so we can use this tool. We're done with the theoretical part. We can use this tool to estimate what the market believes will be the growth of the company. And we can then decide whether we think that set of expectations on growth are fair or not. We're going to use that as our bogey. All right. Now the key here, it's the market implied value of NOPAT growth. So just keep in mind, it's not revenue growth. It's actually NOPAT growth. NOPAT growth is a function of revenue growth and changes in margin. And revenue growth is a function of unit growth and changes in prices. So you want to think about it. This really teases out the market implied value of NOPAT growth. All right, now here's some formulas. I'm not going through all the math, but just so you have it in time. It takes a minute. But growth, the annual implied growth rate, the market implied growth rate is equal to the market implied value of growth divided by enterprise value. So the percentage of the enterprise value that is accounted for by that second piece, or enterprise value minus earnings power value, times the discount rate. That's your market implied value of growth. Or there's a second formula, they're identical. You can take the discount rate and subtract from it NOPAT divided by enterprise value, which is essentially your discount rate minus your NOPAT cash yield. That is your market implied, long-term market implied growth rate. All right, so let's take a look at Apple, everyone's favorite. Here's their enterprise value. It's grown a lot over the years. As you can see, this is just annual figures. Stock's been a monster stock, less so over the last 18 months, but a big stock over the last 4 or 5 years. Here is their earnings power value, which all I did was take their NOPAT and divide it by a discount rate. And that gave me the earnings power value. This is their enterprise value. So the difference between the two is clearly your market implied value of growth. And we have that component. And then we can isolate so this is the market implied value of growth. Interesting, Buffett started buying stock in 2015, 2016, and the market implied value of growth was very small. He sold some stock in 21, market implied value of growth was very high. Interestingly, he bought more stock this year, very different purchase than the one he made 5 or 6 years ago. All right. Here's your market implied value growth as a percentage of NOPAT. I'm sorry, one more time. It's early. Market implied value of NOPAT, and market implied value of NOPAT growth as a percentage of enterprise value. And then we can compare that to the S&P. So the S&P 5-year average is about 45%. And you can see that Apple actually trades at a premium to the S&P. Now, this is similar to relative PEs, but it's much more explicit in my mind. I think it's really interesting because it looks at the market implied value of growth as a percent of the overall value of the company. PEs are a little tricky when they're polluted because we tend to use accounting earnings. I think NOPAT's a much cleaner representation of the steady state business. And then it's hard to really understand what part of the PE is growth. And so we're being very explicit. So in Apple's case, the market implied value of growth is right now just over 50% of the overall value. So half the value comes from current earnings, assuming no growth, and half the value comes from anticipation of growth. All right, as I said, we can actually use this to tease out the actual implied growth rate. I'm going to use the first formula, it's just easier. And so there is your market implied growth rate. The orange line is what the market believes is the steady state long-term growth rate of Apple. And so you can see that the growth expectations are as high, they're higher than they were a year ago, interestingly, and as high as they've been any time in the last 10 years. Actually, I have a chart that goes much further back. These are the highest growth expectations we've seen in Apple in 15 years using this methodology. So expectations for growth are still relatively high. Now, how would I use this measure? What it is, well, the industry, you go look at the cell phone handset industry, that's probably not going to grow that much. I don't know, maybe 2-3%. That's going to be your top line. What do I think pricing is going to do? Inflation aside, pricing tends to go down in electronics over time, so I don't think I'm going to get much there, although product mix is going to continue to evolve. So maybe the top line revenue growth should grow in line. Now you stop and you say, how much market share can they take or not take? And so that's kind of what you want to compare this growth number with the historical expectations, which is what we're doing here. But then you can also compare it to what you think the industry would grow. And you've got some simple things: unit growth times pricing times changes in market share. Do you think they'll take market share, lose market share? And then Apple is very profitable. Their profitability right now is as high as it's ever been, so probably not going to give them much margin expansion. And as services come on, margins actually might come down a bit, ironically. So I sort of look at the 4.4% really as a unit growth rate expectation overall, and that's as high as it's ever been in the company's history. All right, interesting. All right, so there it is, isolated, so you can just see it by itself. In the most recent quarter, product revenue was up 9% year over year, but we've seen that before, zigzag. And what you saw is really kind of a COVID spike in 21 as people upgraded their hardware because they realized they were going to be working more remotely. All right, so this would be the challenge. And then there's lots more you can do. We do a full case on Apple in class. All right, we actually can now take these tools to the S&P 500. There's your S&P earnings through March. I don't yet have a June number. It tends to be very lagged. There is your earnings power of value for the S&P 500 as a percent of your enterprise value. I'll just jump to a step. There's your 10-year average. There's your 5-year average. So the S&P is trading essentially right in line with where it is between 5 and 10 years. I think a lot of people think if rates stop going up, this thing is probably correctly valued. And from a earnings power value, it certainly looks that way. This is the same chart in a slightly different format. I think with the gray, it's easier to see the trends over time. All right, so the opposite of that is your market implied value of growth. That's your enterprise value minus your earnings power value. And so you can see that we're also right in line with the 10-year and 5-year average. That should make sense because that's the mirror of what we saw before. What's interesting is same chart just filled in with bars. You can see the market got to be, it's tempting to say the market got very expensive, but a better way to say it is growth expectations for the S&P 500 got very high a year ago. And with hindsight, that ended up being a kind of a sell signal. Now rates have certainly driven that forward. Of course, that's been a factor. But as we drew these charts last year, I've been playing with these charts for the last couple of years, it did look like investor expectations were pretty high. I think this is kind of an interesting opportunity. If you go back to June of 11, there was actually no market implied value of growth in the S&P 500. The economic environment was pretty tough, but you were paying nothing for growth. And you compare that to last year in 2021, you were paying a significantly high portion of your valuation for future growth. Now, what's important to take away is this is what you're paying for. You're paying for it. So you're only going to make money if the overall the results are higher than your expectations. All right, here's just some discount rates so people can see the discount rate that I'm using. I'm using the 30-year bond rate plus a risk premium to get my discount rate. So all of these are discounted back using a changing discount rate. I don't keep it steady. All right, now here's your market implied value of growth, but with the, now we've teased out using the formula, we've teased out what the growth rate is. And even though market implied value of growth is actually within the 5 to 10 year range, because rates have ticked up, as you see on this chart, and it's a multiplier, we actually, the market implied value of growth is significantly higher, relatively higher than the 5 to 10 year average, not as high as it was a year ago, but on a pure growth perspective, it would suggest the market actually is a little bit expensive from a longer term growth perspective. Now, if rates were to come down, that same number would come down a bit. All right, and then here's the distribution since 2013. I just looked at monthly market implied value growth as for the S&P 500 as a histogram, and you can see where we are in the last, this is almost 10 years. We're at the very far tail of what it's been over the last 10 years. So another suggestion that current growth expectations are still probably a little bit high overall. Now, here's the market implied value growth for the sectors of the S&P 500. Blue is current, orange is your 10-year average, and gray is your 5-year average, just so you can see. And that's consistent with the chart above, where you can see most of the sectors are still above their trend, their 5-year and 10-year averages. Now I did, and then here's your, so that's just your market implied value growth. Here's your implied perpetuity growth rate for the same thing. Blue is current, orange is your 10-year, gray is your 5-year. And you can see that these implied growth rates are much higher than where they have been over the last 5 to 10 years. I isolated tech since that's everybody's favorite. You can see tech versus the S&P 500. Tech has sold off a lot, but the market implied value growth is actually still very high as it was in 17 and 18, or not quite as high as 17 and 18, that was a peak, but almost as high as it was a year ago. So tech, quote, is oversold and everybody's excited. If you go really look at the implied growth rates, I'm not convinced it's so oversold. That's your percentage market implied value growth. And then here's your implied growth rates. And because rates are up and it's a multiplier in the formula, we actually have higher growth expectations in tech today than we did a year ago or even 5 years ago. All right, so I think that's it. I will stop sharing. Jim promised a little Q&A if anybody has any question.
Okay, let's put on. All right, Paul. Thanks for that high-level stuff. Well, I think everyone's either stewing on what you said, or they're just you know, kind of pondering it for a little bit more because we've got no questions.
Oh wow!
So, is that a good
I must
thing or
have
bad
answered.
thing?
that means I answered all of the question. That's how brilliant the president.
That's what I meant to say. You've answered everything.
No,
But,
it's new stuff. It's things I've been, well, in some ways working on for a long time, but we really kind of came together over the last 6 months with some help with some students. The challenge is growth. It's always been growth. Will continue to be growth. And what we're trying to do is just chip away at that iceberg and see if we can, maybe a bad analogy given global warming, but chip away to see if we can get better and better insights. And kind of over the last couple of months, particularly with the charts coming together, we started to be able to tease out what that implied growth rate is. It probably seems very high level, but when you go look at somebody like Apple and you look at their historical growth rate, they haven't grown much faster than 4%. Unit growth anytime except in COVID. And so do you think the world's changed? I think the challenges, it's a brilliant company, phenomenally profitable. They've done a great job on execution, shy on innovation. We haven't had anything all that interesting in 10 years. Over the last 10 years, they spent 120 billion on R&D, and we certainly have some fast processors, and we have AirPods and the Apple Watch, but nowhere like the innovation that you saw when Jobs was running it. So where's that growth going to come from? Well, it's always new products, and they're not going to pre-announce new products, but it's got to come from the industry. 65% of the product revenue is still the iPhone. 65% of product is the iPhone, and product is still well over 50% overall revenue.
thank you, Paul. Listen, as you've been speaking, we've prompted a few people that have come in, so I'm going to rattle off a few questions for you and test your knowledge. And so first one is, would we expect to see higher values for market rate value of growth in less competitive markets?
Oh, for sure. But you get two things. Your earnings per value tends to be higher in less competitive markets because they tend to be more profitable. So that dampens some of the growth. And that's really where you see the lift in valuation, is because of that. And that's important. What you will get in those markets, it's still the growth rate is more valuable the higher your return on capital is, but you still want to go look at the market implied value of growth is. Now, where we haven't, I don't know, I think some of this stuff's really cool, but for high growth companies are growing 15, 20% annually right now, you're going to get a market implied value of growth in the high the high single digits, 8, 9, 10%. And if you're growing 15%, that looks like an easy bogey. But keep in mind that this is a perpetuity growth rate. This is the growth rate that they're going to have to deliver over time. So if I'm delivering 15, 16% and my market implied value of growth implied is 8, 9%, fine. But as you start to slow that growth rate down, that 8, 9% becomes really important to keep in mind. Because if they get closer to that, that's going to be a disappointment.
All right, thank you for that. A couple more for you. We're going to go through them. Second one is, you mentioned the discount rate, and you mentioned you vary the discount rate. I'm sorry. Can you tease out the logic there? The valuation of a company is the discounted cash flows of a company from now until Judgment Day. Assuming Judgment Day is far away, would it make sense to normalize the discount rate?
Yeah, I think so. I actually, in the S&P 500, we have the data. We can use the actual discount rate. On the companies we look at, I just pick a discount rate. It's easy. I almost always use 10 to start. Why not make the math easy? By the way, if you go through a deep calculation on Amazon's cost of capital right now, you're going to get something like 9.8, 9.9%. You might as well use 10. So I tend to just normalize the discount rate. I don't think that's the most important factor in analyzing companies. So yeah, pick a number that you feel comfortable with. Absolutely.
All right, thank you for that. And here's one probably more than one person is thinking, but you've been asked, have you looked at Tesla?
A little bit. And this, indulge me for 90 seconds. The challenge with Tesla is you have to decide what the steady state operating margin is. Now they've got a couple of businesses, so it gets complicated because at the moment, Tesla, the bulls will tell you he's investing everything he can to grow the company. And therefore you have to look to get to a steady state, you're going to have to assume higher profitability. So your first step is you got to come up with an operating margin you like, and then you can do the analysis. And what you get is very high growth expectation. but it's sort of irrational numbers because this is the market implied value of no PAT growth. So it's better exercises, come up with a target operating margin, pay some taxes, blah, 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 get a net margin, then do the analysis. So do it as a two-step, forecast what you think the operating margin is, and then do this analysis, and you're going to get very high growth expectations in a highly competitive industry.
Fantastic, man. Well, listen, we're wrapping up there. As always, great insights. You got a new book out, I think, haven't you?
Well, we're working on a book, and this will be shocking. It's called The Value of Growth.
Well, great. Well, there's a good insight into what you're going to get. And like I say, Pitch the Perfect Investment is a great one, really. I thank you for your time today, Paul. Really appreciate that, as always. I'll be as smart as you one day. We've got the same shirts on today. Look, you see that?
Yeah, I like that. I got the memo. Thank you.
But
all right, Jim, congratulations on number 6. I can't wait to see what everybody has to say. Thank you.
Absolutely, man. I'll see you soon. Thank you.
Thanks. Yeah, bye.
Bye-bye. Okay, so we're going to bring on our next guest, and our next guest is another mainstay of our conferences, actually. His name is David Marcus. Now, David has been around for a long, long time, and the joy of David's knowledge and insights is the fact that he's seen many, many markets, many awful markets, many good markets, and he's lived through them all. And he's here to tell the tale. And I think that by itself is testament to what he's going to talk about today. But with David, he approaches the markets a little different, I think, than most people. Not looking at value, but looking at value with a catalyst, but also company conglomerates, which I believe he's going to talk about today, and the value of those. So, and also what's interesting about David, he's got a good pedigree in terms of his learning. He studied under Michael Price. Michael Price, you know, a great value investor, legendary value investor, in fact. And Michael sadly passed away, I think this year, was it this year? Yeah, early this year. And lo and behold, you know, the news is, exclusive news is with David, is he's going to take control very, very shortly of the Price family office. So he's gone from student to the teacher, which is very, very exciting. So I'm just going to switch over to David. He's beside me today, actually. We have the pleasure of him. And we're going to just switch over PowerPoints, and so bear with me a couple of seconds, and we'll put David on.
Thanks, Jim. And thanks for inviting me in. I'm really happy to be part of this. I know you do this for a really important cause, and I really think it's fantastic that you do it, frankly. So I think I have not been here 6 times like Paul. I think I've only done, what, 4, maybe 5. So, but again, I appreciate being called back. So yeah, I'm going to focus on, as my presentation shows here, family-controlled companies. I talk about how they have a shared DNA, which is value creation. We love looking at conglomerates. We love looking at holding companies. We find that a lot of investors don't like to look at these kinds of businesses. The world has evolved to where people really want focus. And if you're a conglomerate, you tend to get valued at the weakest link, meaning your lowest margin business, even if it's a tiny percent of your portfolio. We also like family-controlled businesses where there's a main owner. They've been around for a long period of time, sometimes multiple generations, and they're very good stewards of capital. So I'll get right in here. Let's see if I can. Sorry, I'm at Jim's actual event, and turns out he's a righty and I am a lefty. So just bear with me a second. There we go. So just a second again on what we do. My firm is Evermore Global Advisors. We are special sits investors. We've been around for about 14 years now. As Jim pointed out, I used to work for Michael Price. Michael gave me my start on Wall Street back in 1987. I answered the phones as an intern from Northeastern University. I stayed almost 14 years. And I went from answering the phones. By the time I left, I was managing or co-managing more than half the firm's assets, about $14 billion. That business became Franklin Mutual after he sold his business to Franklin Templeton. So, and the foundation of everything that we do at Evermore really is, it harkens back to what I learned working for Michael. I was lucky that after I worked for Michael, I partnered with a Swedish industrialist named Jan Stenbeck. Jan was a true visionary in telecom and media. If you go way back, he was one of the people that helped create Vodafone, but he started his own telecom and media businesses here in the US and in Europe. And when I partnered with him about 20 years ago, and sadly he passed away, he was pretty young, he was in his 50s. At that point, I quit the business for a few years and I helped build his family office for his kids and sat on boards. And what that gave me was a unique perspective from the inside of companies, how they really work, what it's like being on a board, dealing with management, trying to understand how the businesses work from the inside out. Because as we know, as an investor, you're only on the outside, you're looking in the window. You don't have all the information, you don't really understand it except from the outside looking in. When you're on the inside and you can see how it's actually done, you get a completely different perspective. So that helped us evolve our way of investing and thinking to just take really, it's all about data and knowledge and understanding and having, as I would say, a 3D perspective of your businesses from every possible angle. There we go. So, and I'm going to give one specific idea today, but I'm leading up to it. So we focus on family-controlled companies, or as we call them, FCCs. It's a company where typically you have a family, or it could be two families. They control a fair percent, at least 20% of the votes, maybe more. But they're not just control shareholders. They also have their DNAs in the business. They're the chairman, they're on the board. The whole way the business is managed is sort of levered off of the family's old history or the founder's perspective. I think that's critically important. And so why do we want to partner with family controlled companies? Well, the data proves this out, that over long periods of time, companies where there's a main owner have tended to outperform the indexes. And why? It's almost commonsensical. It's because they're thinking longer term. They're not investing for this quarter, for next quarter. They're making decisions on allocation of capital, on who they should hire, projects they should invest in, all kinds of decisions, and they're geared with long-term outcome and long-term value creation. I touch on some of that here on this slide. For them, it's a primary source of their wealth and the continued creation of their wealth, meaning they're really tethered to the company. Usually it was a company where there was a real value creator at the helm. They probably didn't even think of themselves as value creators. They were business builders. And if it's the next generation, have they taken on the legacy of the predecessor? Did they go in a different direction, but on the foundation of what they learned? So we really, effectively, we say we are investing in jockeys, not just horses. Now, of course, you need a horse that has a chance to win, meaning you need assets and businesses that can actually perform well. But without the right leadership or jockey, you're not going to win. The horse itself doesn't know which way to go. It needs the jockey. So we think in those terms. You need a great jockey, but you need a compelling horse as well. And so, but what we also have found, it's not every company that's family controlled that's a good investment. You have to be just as diligent in your homework, in the way you think about it, and you're doing your analysis to understand, are these value creators or might they be value destroyers? And what that means is that sometimes you'll meet somebody who runs a business or their family controls it, and you think, that guy just turned his family's $6 billion market cap company into a $3 billion market cap. He's a value destroyer, but he thinks he's a value creator because he's worth a lot of money. He inherited a lot of wealth and doesn't understand that the decisions that he's making in his business are actually killing it. Why would you want to meet people like that? Well, because you're learning where the minefield has the mines. You're learning what to avoid. You're learning what to stay away from. That's as important as learning what to look at. It's learning what to not look at. So you want to meet both. You don't go in their office and say, hey, I understand you're an incredible value destroyer. Tell me how you do it. It's just not what you're going to do. You want to, you know why you're there. And so you act accordingly. And so then you look for these businesses where they just have a historical perspective of these decisions, and you can see it in how they've operated, that they have compounded well over many periods of time. This owner-operator style, it's critically important. As I point out here on the slide, on the right-hand side, we talk about what kinds of special situations there could be. Breakup, spinoff, transformations, restructurings, whatever. There's change. You have, so these are not family, especially conglomerates, where it's not a one-trick pony. It's really something where it's a living, breathing entity where they're making decisions that will change the trajectory of their compounding over time. So they may look like small ripples, but they could turn into giant tidal waves over time of value creation or destruction. So it's really understanding, what are they doing now? What did they do a few years ago that's starting to kick in now? So it's really understanding that whole perspective. And here I just give a couple of examples. My pick today is XOR. XOR, that's why I have some dotted lines around it to draw your attention there. But I break down the compounders into a variety of styles. At the top, I call them classic compounders. And there's really nothing classic about these, except they're old line businesses. All three of the ones that I list here, XOR, Bolloré, Italmobilier, these are family control groups. They have been around for a long period of time. XOR is around over 100 years. It might have had a different name when the Agnelli family started it, which I know it did. Bolloré, over 200-year-old group, transitioned to the 7th generation over the last 2 or 3 years. Italmobilier, the genesis was Italcementi, one of the largest cement companies in Italy. They sold. They took the proceeds and created their public company is almost like a publicly traded family office. They have a private equity mentality, a very long-term investment approach mentality as well. They make investments with families and others in good businesses that have scale opportunity. So those are my classic compounders. Then you have your M&A types. Vivendi, that's actually controlled by Bolloré on the other line. So Vivendi, when we first invested, it was when the Bolloré family was sort of going after it almost on a hostile basis. And Vincent Bolloré eventually became the chairman of Vivendi. Now his son is, and they had a beautiful gem inside Vivendi, which was a mishmash of all kinds of assets. It was a poor performing conglomerate, but we knew that when they went in, they would do what they've done before: refocus, restructure, reallocate resources, sell non-core assets. And the gem was called Universal Music Group. It owned 100% of the largest music company in the world, which is a US company. So over the years, they went from net debt to net cash. They IPO'd Universal Music. They partnered with, back a couple of years ago, they sold a stake to Tencent, back when that was a high flyer. Now it's maybe 5 cents. I don't know. I'm just saying it's out there. The company has a substantially larger market cap. They've been a great dividend payer over the years. So I look at the total return. It's been substantial at Vivendi. and again, controlled by the Bolloré Group. Lifco, controlled by a man named Carl Bennett. Lifco is a conglomerate. Carl is the first generation. He's in his 70s. He happened to be in New York a week ago. We caught up. Lifco, he IPO'd about 6 years ago. It was a private company. We were begging to be part of that. We're not usually IPO buyers, but we had invested in other of Carl's companies over the years. An incredible businessman in Sweden, an incredible value creator. This was his conglomerate where he put kind of all the odds and ends in, but it has everything from dental equipment to robots for demolition, just solid businesses that he can buy, no turnarounds. He's looking for good businesses run by great people at compelling valuations, and he rolls them into this holdco. It's up 9x from the IPO, and that's only because it's down 45% this year. It was up a lot more. So it's the best investment we've had in our portfolio since we started our firm. And then you have, I'll speed it up here because I really want to get to Exor. You have asset management types, things like Onyx, that's a Canadian private equity. Think of like a KKR, which I show on this page as well. Why do I call KKR family controlled? Because the founders, Kravis and Roberts, and their families are big holders. The management are big holders. This is a tightly held business. Eurazeo is a French holding company, a private equity group. Originally, it was created by the group that controlled Lazard, and Michel David Vey was the chairman. He died, I think, earlier this year. But it now has another family that's partnered with them. That's the family behind JC Decaux. That's one of the largest billboard operators in the world. And so you have two main owners of this group. It has no ownership of Lazard anymore. That evolved out. It's a publicly traded private equity and asset management business. You want these kinds of businesses because they're just recurring revenue. The greatest secular growth over the years, last 10 years, in asset management has actually been in private equity, not in any other aspect of asset management. Restructuring cases, Hapag-Lloyd, big logistics and container ship company, was dead a few years ago. New management came in, turned it around, transformed it, did a couple of mergers, created it into the, I think, fourth largest shipping business in the world. Zim, Israeli company. I think it had 75 years of a tomorrow story. It's controlled by Edan Ofer. I think he's the richest man in Israel. He brought in new management back in 2017. And the guy's first decision was, hey, let's get rid of all of our ships. We don't need ships, even though we're a shipping company. So he got rid of all the assets and became an asset-like business and brought in technology, transformative. They IPO'd 3 years ago at 15. The day after the IPO, the stock collapsed to 11 because it was a shipping stock. Nobody cared. And then they proceeded to crank out an incredible amount of dividends. So in under 3 years, on a $15 IPO, they've paid $30 in dividends. And the stock's just under 30 today. It's down. It was higher earlier in the year. Sky Broadcasting, similar. I'm going to just press on here. IAC at the bottom. I know it's a stock that Jim's talked about in the past. It's been very frustrating in the last 6 or 8 months. But if you look at the history of IAC over the years, it's created by Barry Diller, incredible value creator over time in media related businesses. A couple of years ago, they bought control of Meredith. That's People Magazine, Better Homes and Gardens, a whole bunch of other assets. And they're digitizing and monetizing those businesses. But with the sell-off of a variety of kind of all things consumer, NASDAQ, whatever, the stock has come off precipitously. In the long term, we think the compounding is still been incredible, albeit reduced by the recent significant drawdown. But we like it in the longer term, and there'll be a time where it's just a back truck moment. That's not my pitch today, but I'll now. How am I doing on time?
I think you're about maybe 5 to 7 minutes.
5 to 7 minutes. I
Then
better start.
we want to get some questions.
Okay, hello.
Because
Okay.
they want to ask you questions.
Yes, I hope people are still awake because I'm finally getting into the idea. Here we go. Exor. This is one of the, and I'm not going to read you every line here. I'll read you a couple of them. But basically, Exor was started by the Agnelli family more than 100, I think it was more than 100 years ago now, well, more than 100 years ago. They started with basically creating Fiat cars. That was the genesis of the business, an industrial business. They had a boom bust cycle over many years. In 1923, they bought control of Juventus, the football club, as they would say in Europe, the soccer club, as we would say here in the US. You can see some of the holdings at the bottom of the slide. I list them out and the percentage they own. So they've owned control of Juventus for just under 100 years now, and have nurtured that and really grown it into an incredible team. In any case, the head of the family today is a guy named John Elkin. John is I think he's in his late 40s now. When he was in early 20s, his grandfather basically anointed him. He said, "You're going to take over one day. I'll train you." The family had a whole issue of health issues. Some of the uncles died from health issues. Some more things that were maybe not health related. Other disasters have impacted them. But nevertheless, the grandfather anointed John. And when I think he was 28, his grandfather died. John became the chairman of the group. And what he did on top of the foundation that the family had put in place is just nothing short of spectacular. He inherited an industrial group that was not doing well. The auto sector for them was in trouble. He went to his family. He essentially begged them to put more money in the business. They did. Transformative. He brought Sergio Marchionian, a non-auto person, to run an auto empire, transformed it. They bought Chrysler from the US government during the financial crisis for almost nothing. It's the core of their cash flow today. So very smart, constantly rethinking their portfolio, thinking about how to allocate capital, and really just incredible. I just want to make sure, is this slide showing? Because I'm not sure if it's out there. I just want to make sure you're actually seeing. Good, okay. Somebody sent a note saying that they couldn't see it, but I think that's fine. In any case, so just pressing on here, you have what I call cheap on cheap. Some of the underlying assets are also undervalued situations. If you look at just Stellantis and C&H, that's effectively the market cap. So two holdings, you're getting the market cap. Now, on top of that, you have 5 billion euros of net cash. You have stake in The Economist, Juventus, Ferrari. They recently have, in the last couple of years, have changed their trajectory again. He started investing in healthcare. He started investing in more consumer products and luxury brands. That's why they control Louboutin. Louboutin, as many of you may know, is the famous shoes that are red sole bottoms. You see, I'm not wearing mine today. Actually, they're women's shoes. But these are high growth, high margin businesses. So what they've quietly been doing is evolving out of industrial assets into these higher margin, high growth businesses like healthcare, like luxury brands. And so the steepness of their compounding is evolving. The stock trades at about a 32, as I show, % discount to our calculation of the NAV. We think that's a conservative level. We really are conservative on the way we value the pieces. And they have the war chest of cash as they go forward. They're looking for targets. We're heading into an environment of compelling opportunities coming their way, and they have massive buying power. But the key is that he has hired incredibly talented people around him and throughout the organization. And then he doesn't tell them what to do. He unleashes them to their skills. And so this is one of our favorite holding company and conglomerate cases because it's just been proven. They've compounded the NAV at about 20% for at least the last 10 years. At least, and the stock's down in the last year. So the compounding was even higher. Now the discount was higher. If we look back maybe a month ago, it was probably in the low 40s. So the stock has moved from about 60 to the low 70s. I don't know if the discount will ever go away. That's a bonus if it happens. I'm here for the compounding. He's doing all the hard work. We could sit back and relax. We spend our time filtering out to find people and businesses like Exor And then we want to unleash them to do their thing by sitting back and just tracking and riding their coattails. And so this is our my favorite pick of quite some time, and I thought I would talk about this today. I'm going to open it up for questions if there are any. Bear with us. So the question is, you mentioned that you vary discount rate. Can you tease out the logic there? The value. What's that? Oh, I'm sorry. I'm reading. Now I'll read the questions that are for me. Can you use this tool to understand the value of income? No, that's still for Paul. Okay.
Is there no questions?
Okay. What percent do you like to see in a family-controlled businesses? Is there a sweet spot? Thank you. You know, I showed it earlier. We say about 20%. It's really, we've seen companies where they own 12 or 13%, but they control it. They dominate the business. And so it's really not, you don't want the number to drive every part of your thinking. You want to understand, is the family, is there DNA in there? Are they really controlling it? But as I said before, it's to just add on to that, it's not just, like I said, not investing in all companies where there's a main owner. You really have to make a judgment call on who you're investing in, because frankly, there are families that are not shareholder oriented. I don't care if they don't think about the shareholders. I care if they work against the shareholders, because then I'm not interested. If they kind of let us tag along with them, we're happy to do it. But we have to understand that we're making a judgment call on these jockeys, and Exeter has proven themselves worthy, and that's why we're here. And again, don't focus so much on the percentage. That just should draw you to look at family controlled businesses, understand who they are, how long they've been around, have they delivered, and how consistent over time has the compounding really been. Any others? Come on, I had to get up so early for this. No, that's okay. Well, again, Jim, thank you. Everybody who made a donation, you're welcome to double down and do another one. And but I'll hand it back to Jim now.
Oh, yeah. Thank you, David. Always insightful as ever. So, you know, you can see kind of how people approach markets and stocks in different ways, you know, the conglomerate idea and the shareholding of families and the way they're incentivized. And it sort of brings up to our next guest. You know, you might follow me on the Forbes blog, Jim Osman Forbes, if you Google that. I kind of give a lot of personal insights into, you know, things I find interesting about investing, and maybe not what you normally want to hear or do here. So, and one of those is along, like I say, following on from David, is the idea of insiders. Now, you know, we get a lot of press out there, so-and-so selling this stock and they're buying this stock, but really, what does it mean? It can mean various things. You know, people selling stock, you know, there's that great quote from Lynch where he says, you know, people buy a stock for one reason. Well, they do and they don't. You know, you'll be surprised that a lot of insiders, and when I say insiders, I want to clarify management or people associated with a company, they can buy stock, but they might not be that good at buying their own stock. So never assume that these people who are buying their own stock know what they're doing. Now, George Muzea, our next guest, is again one of those people who've just seen markets, been around for a long, long time, worked with the likes of Druckenmiller, you know him, and Soros, and really the premier analyst in the world looking at insiders and their behavior and the way they buy and sell stock. And he'll go into a lot deeper detail than I can. But certainly, if in your investing armory and what we do here at the Edge is really look at the insiders and how they're incentivized. Because again, you know, people or managers, there's a lot of managers who are incentivized but won't respond to incentives. And that's a problem as well. So you can be buy stock, you can't know what you're doing or not fully know what you're doing or fully able to predict the direction of stock. You can be incentivized and not respond to it as well. So kind of going through all that stuff is what George does. And he's an expert in that respect. I'm going to bring George on. He's going to give you an idea. And I said one of the recent articles, I said the market will not bottom unless we see insider buying. And we've just not. And so that continues to go on there. So, you know, again, you've got to see people buying their own stock across the board, really, for you to get some sort of hope of the whole market rising up. But George will give you better insights into that than I could. So I'm going to hand you on to George, and he's going to give you a little bit more color in that respect.
I would like to say that, Jim, you forgot to mention that I'm a legend in my own mind. But thanks for the introduction, and it's good to be here. I have a comment on David's stock, which I will get to in a little bit. But first, I want to talk a little bit about short sellers and long buyers in a bear market and a bull market. And let me just state that, like Paul and David, I just didn't wake up one day and discover the holy grail of insider analysis. Clearly, I made a lot of mistakes. Shorting some momentum stocks was one of them that taught me lessons. Buying in 1973 on the way down and having no clients left. I was a stockbroker with Oppenheimer at the time, and in 74 rather. And I made money for those people who listen, but most of my clients were long gone by the time the bear had reached its bottom. So for short sellers, unless you're Stan Druckenmiller or Soros, I strongly believe that you should follow my advice regarding how to make money in a bear market with stocks. Clearly the way to do it is to try not to avoid the temptation to top tick a stock. Most people who are short sellers, other than the really sophisticated guys like Druckenmiller or Soros, they want to short a stock right at the top so they can brag about it on the golf course. But most of the time they'll lose money. What I've learned over the years is that you want to only look at shorts that have already had been punished. The momentum players are out of the stock, so stock will be down 20 or 30%, and then it'll start moving sideways because value institutions like Barry March and other value investors will start buying. They believe it's a non-recurring problem that got the momentum players out, and they believe the worst is over. But if I see insider buying into that lateral price movement, especially if there were insiders who were operating officers who were selling on the way up, then I know that it's not going to be a non-recurring event. And this time, when the bad news comes out, they've lost everybody. They lost the momentum players at the top, and then they lose the value investors. And these are great shorts. 80% will be winners, and they'll be big winners, because there's no hope for the stock after they've lost those two classes of investors. One of the examples that I have, I'll just tell you about, was Enron. When I was advising Alliance Capital, they had a small hedge fund, 175 million, and I was one of the advisors to it. And Enron had this, especially the CFO, forget his name, but he was selling on the way up. But then some bad news came out. Momentum players left. The stock dropped from 90 to 60 and was moving laterally. These same offices that were selling on the way up, and some new offices started selling into this lateral price movement. And that was a great short because it went to zero. So that's my advice on the short side. And you're going to have plenty of these opportunities in this market over the next year or so. And just look for that. For long buyers, there's two types of markets, obviously, where you have different ways to play it. In a bear market, you don't average down, even if insiders do. You only buy stocks after a stock has built a base and starts up with sponsorship. So a stock, the first group of buyers are value buyers, and they'll just keep buying all the way down. They're working for the company, they care less. And in 1973, 74, and 08, 09, they bought all the way down. And then when the market turned, in cases, in 74, it went down 60%, then up 60%, 75. And same in 09. So what happens in a case like that is you have the public is out of the market, or they give up at the bottom, and the institutions lose many clients as well, and money. But if you so my advice there is you wait till the stock has built a base and then moves higher, and as it moves higher, you're going to see the stock instead of buying out of this base that's been built. As the stock moves higher, these insiders are no longer value insiders; they're catalytic. They only buy because they know good news is coming. So since it's already got sponsorship, the stock's going to continue to move higher. So that's the way to play that. And maybe what we could do now, Paul, Alex, if you could put up the chart of Intel. Now here's Intel. This is a bad example. This is what you don't want to be doing, and this is probably what's happening to many people, because I see it on Bloomberg. I see insider trading, and the stock goes up a point or two, and on any stock without any concept of whether the insider is smart or not. Take a look at this. Insider buying at 56, 48, 45, 34, recently at 28. Now that's, that, and Hasbro is another example. Insiders buying all the way down. And so I feel sorry for the poor individual investors or institutions who follow them, because if they're advising people, the people they're advising may sell out at the bottom in disgust. And if you're a personal investor, if you buy stocks like this, by the time the market bottoms, you're probably so bagged and depleted of energy and money that you're not going to participate on the way up. So avoid insider buying into weakness. Let's put up Micron. Alex, thank you. Now this is a case where the CFO was buying $17, $14, $11. The stock kept going down, moved laterally, and then at $28 he bought again. And so you would say, well, if I had bought at 11, but a lot of people won't stay for 2 or 3 years in a stock and keep buying it because they believe in it. So when he bought again at in the 20s, it was fantastic because the stock eventually went to 70. So that's an example of what I think you should be doing in a bear market, because in a bear market, your stocks are going down, and you don't want to keep averaging down because you might get disgusted and sell out at the bottom. So clearly, you wait until the stock bases. Stock gets some sponsorship. Somebody puts out a buy recommendation. Stock goes higher. And then insider start buying. These buyers are no longer value buyers; they're catalytic. Okay, let's go back, Alex. Thank you. Oh, no, not that. I want to go back to, yeah, that's it. Okay. Okay, so so we talked about bear market buying. Now, bull market is different. In bull market, you can buy if a stock is broken out and insiders are paying up as well. That's momentum buyers. Any momentum stock that has insiders paying up is wonderful to see. And you buy if a stock is corrected, but only in an uptrend and insiders buy the correction. And then if a stock is in a downtrend and value insiders are buying, you can buy if someone in the cluster has a good trading history. So it's a lot easier to make money in the bull market. Bear markets are killers. Let's put up. Let's go to the next page. Okay, good. Okay, now, well, before we talk about what to look for in this bear market, assuming we're in a bear market, and it feels like it, let me talk about this one stock that Dave mentioned. Let me see if I can get my other. Yeah, okay. He mentioned this stock. He mentioned the stock Exor. Yeah, Exor. Well, what's interesting about Exor is that they had a new chairman who came on to his name is Banga Ajay Banga. He's 62 years old. He has a bachelor's degree in economics from Delhi University, graduate of honors, alumnus of the Indiana Institute of Management. He was awarded by, so he's a really smart guy. He joined the company in 21, and he made his first purchase of 909, let's say $1 million on the 23rd of May this year. And then on May 24th, he bought another $1 million. And then on May 25th, he bought 500,000. Now, what's interesting about this guy, the stock obviously is an uptrend. It's been moving laterally for a while, but he was also the director, a CEO of MasterCard, and he was president of Citigroup. So this guy's been around, but interestingly, I can't find any buys in these other companies. So in fact, he was mainly just selling stocks that he got from options. So here's a guy that joins Exor that Dave likes, and he's got 3 insider buying. So this is a divergence from normal behavior for him as an important person in the company. So it just supports what David had put out. Okay, now let's talk about how do you identify what experience have I had in identifying a market bottom? First of all, hedge fund sentiment right now is 50%, and 70% would be very bullish and 20% would be very bearish. And they're at 50%. So hedge fund sentiment is not there, and at this point in time. But in a true market bottom, a major market bottom, they will be like 2009. They were actually 17% in 2009 at the bottom. Active portfolio manager sentiment. These are, some of them might be hedge funds, but most of them are outside managers, might be working for AIM or whatever, but not running a hedge fund. And their current sentiment is in the 50% area, and they in 2009 and 74 or most bear markets that I have seen, major bears, they'll be in the 10% net long or net short. Then you'll have a deeply oversold market with most sentiment indicators at extreme fear levels. It's not, well, a wise old man once told me when I was a young fella, Dow Jones average will bottom out when you're 25% of the Dow Industrials is 25% below its 200-day moving average. But a deeply oversold condition, everybody knows what a deeply oversold condition looks like. You've got CNN fear greed index. It'll be extreme greed, extreme fear. Right now, it's almost extreme greed. And then you'll have massive aggressive buying by insiders. And these insiders will not be catalytic buyers. They will be value buyers. They're the ones that'll be just averaging down. You know, in 74, the market went down 60% and 40% in the last couple of months. And the insiders were buying aggressively all the way down. But then it went up 60% in 75. They made out like bandits. They're working for the companies. They could care less. They were buying their value buy. But the public, if you're managing money, you're not gonna be around. And if you're a private investor, you'll give up and sell at the bottom. Those are that, and then not necessarily, but many bottoms will have a negative news story. Alice, can you move to the next page and see if that shows up? Is there another page? Yeah, there it is. Many major bottoms have a negative news story that gets nervous investors and mutual funds to sell. You know, one of my clients 20 years ago was Alliance Capital, and they had a hedge fund, $175 million hedge fund. I was their only advisor. I wanted them to make me one of the partners, but they already had 3 guys, and so I wasn't invited in. But in any event, I remember being in the chief investment officer, who was one of the 3 guys that were responsible for the fund that I was advising. I was in his office. We were talking about some different things, and then at 3 o'clock in the afternoon, I got someone stood outside his office. He waved him in. The guy gave him a piece of paper, and he left. And then the CIO, chief investment officer, he typed some numbers in, and I said, "What just happened?" And he told me that every day at 3 o'clock Eastern time, they get, and this applies to AIM and any other public mutual funds. There's $6 trillion of them, $6 trillion under management in public mutual funds. And so he says every day we get an indication of what our investors want to do. And so what happens is, in that case, it was $10 million was going to be bought. And he types in 10 million and it comes out equally distributed over all the stocks. It's not like they do any analysis. It's just a standard thing. So what happens is you get a negative news story usually at the bottom, and that negative news story is scares the hell out of the public, who are already scared. And public funds like Fidelity, AIM, they're mandated to be fully invested. My biggest client was Fidelity. It had like 9 managers there and a few researchers. And I remember getting a phone call from the head of the biotech group, and he said, "George," he says, I'm going to get fired if right now I'm 15% cash and I can't be more than 5%. I'm going to get fired. And I said, "What do you want me to do?" I said, "I'm bearish." He said, "Well, can you help me get more defensive?" Which I did. And what happens to these guys? They get tired of this and they go off and start a hedge fund on their own. And in any event, so they're mandated to be fully invested. So the negative news story gets fund investors to sell, and which causes the capitulation that seals the final bottom. my wife, father, my father-in-law, he called me on March 2nd. I think it was a Sunday, and he called me and told me his name was Andy, and he called me. He said, George, he said, my 401k is down 50%. I can't take the emotional pain. I'm going to sell tomorrow morning. And I said to him, Andy, please don't. I'm buying. The market's very close to a bottom, and I'm putting out a buy signal to my clients. And I beg you not to do it. He didn't do it. And in fact, he bought more, and things worked out well for him. But so that was so the negative news story in 2009 was Warren Buffett. Warren Buffett was speaking with Maria Bartiromo, and she asked him about the market, and he said the economy has fallen off a cliff, and that caused these fund investors to put through, and there was an avalanche of selling in the last hour, and there's your bottom, and that seals the bottom. So
George, I'm gonna jump in because we're time short, but also we've come in with a question, and I want to ask you that. Got one from David, and he says that how do you treat stock ownership requirements when you assess the veracity of a purchase, and further, how do you treat management turnover if the insider that gives you a buy signal leaves the company? How do you approach that, George?
I look at what I do is I look at the track record of the individual, and I look at where the stock is, whether it's in a downtrend or an uptrend. If it's in a downtrend and this man is buying, and he buys because he's had a track record of buying bottoms in the past. That's interesting. If the stock's in an uptrend, he buys. That's even more interesting. But as far as whether when he might leave the company, I don't want to get into any of this political stuff. I don't look at it. I just look at the track record at the time he buys, and whether we're in a bear market or bull market, and just basically what I mentioned before.
Okay. So
by the way,
okay.
by the way, before you ask me another question, for those interested in my book, I have a website. It's called vitalfew.info. Two things. One, you can get the book there, and you can get the book awfully cheap. Two, there's a link to me. You can ask me a question. I'll be happy to go over any stocks or of the people's interests or my views on the market, or any questions they might have. I'm pretty good at answering people.
George is excellent answering people, and there's his book right there. I can thoroughly recommend that book, The Vital Few versus the Trivial Many. It's the 80-20 principle, where a lot of this a lot of things in nature adhere to. So you can have a look at that. It's got the magic tea, which he talks about. It's an excellent read, really excellent, and will fill you with knowledge that you won't normally hear. So I mean, I've got a question for you, George. I guess maybe everyone's thinking about this one as well. It's like, okay, I get it, right? I get the buying of the insiders. I get the selling on the way down into strength, catalytic value. That's great insight. So if I was to be a buyer of the market as a whole, is there something in your experience, and you've seen a lot of these bottoms throughout history, is there something where there's going to be a breadth of market buying that you say, well, you know what, is every sector is buying, or these particular sectors lead the way, or is there anything like that? Because at the moment, we've seen nothing.
All right, let me interrupt you, Jim. First of all, I have never seen, and I've been in bear markets. I started in 1966 with E.F. Hutton, and I've seen everything, and I've seen a lot of bear markets, and I've bought a lot of bear market bottoms. But I've never seen a bear market bottom where you didn't have tremendous fear into a market that's deeply oversold, with massive insider buying. In 2009, there were so many buyers by insiders. There were so many stocks you just want to give up. So clearly, if you get hedge fund sentiment in the 20% area bullish or net, and then active manager net short, and you got a deeply oversold market with negative sentiment and massive insider value buying, it doesn't matter what the hell you buy. You can buy anything. Everything's going to go up. You can just buy the ETFs for the spiders and the QQQs and the diamonds. But we're so far from that we haven't seen that. And I haven't, in May, for example, I did see a pickup in buying, but not anywhere near what we had in March of 2020. Which was the good bottom. So right now there's insiders selling more than double what they're buying, and the dollar volume of their buys is very small compared to the sales. So I love this, what I do in the area, the macro area, because I don't have to try and figure out all this other stuff. All I have to do is wait for these rules I've discussed. I could give out stocks and things like that to people, but if you're a stock jockey, that's probably what you want. But I'm providing information that like Dave and Paul, they didn't just wake up one day and discover the holy grail of what they do. I learned through the years, and so I'm saying if you're looking to buy stocks, you don't follow them insiders on the way down in a market that's like it is right now, where Target blows up and Walmart goes up. It gets crushed and then Walmart goes up. We're not in a good market, in my opinion. But I know what the bottom will look like, but I don't know when it will happen.
I also think that, a lot of people are waiting on that. You talk to people, there's got to be some sort of capitulation event. And that's very true in history as well. Lehman's, arguably, this FTX thing recently could be the event. It hurt a lot of people.
You never know what the event's going to be. I'll tell you another, I live in a very substantial area, and there's a lot of CEOs of companies and a lot of smart people. But I remember when 9/11 hit, you remember when they closed the stock market and then it reopened? Mm-hmm. And I had massive insider buying. And I was talking to these guys who were filled with IQ much higher than me, and they were successful, but they sold out when it reopened. And that was a huge mistake, because that was the bottom. And so the problem is that bottoms and tops are made from human nature, and they'll never change. 1,000 years from now, someone will be we're talking about market bottoms.
Yeah, well, I also think that it's just like stocks, markets can stay cheap for a very long time, particularly on retracements, because in 2001 too, when the tech collapsed, it took 12 years for the S&P to get back to its highs. 12 years. I don't think people remember that. In 2008, it took 4 or 5 years. So, we could stay cheap for a while. And I think that this is where, your strategy, our strategy comes in respect of looking at catalyst events. What's going to move the stock? I always say, the 3 in a row. Let's have a cheap stock. Let's have a catalyst, and also some sort of insider buying as well, to really push it to make a good investment in these sort of markets. Otherwise, you're buying cheap, and your cheap is 10% cheaper the next day. I think you're right on that. But I think on a market basis,
sorry interrupting you, but what you're really getting to is sentiment, is patience. You don't have to. If you're not a money manager, you don't have to be in the market, do you? You can be out playing golf, working on other things, work on your health, your religion, but wait for these opportunities. They will come, but it requires patience. We haven't had a really good macro bottom in this market, since 2009. and who knows when it will happen, but I know what it will look like. And I know that it's not here. I mean,
All right, George.
we're
All
not
right.
anywhere near it, but if I get what I want and we have that at the bottom that I want, you can't help but make money.
All right. Well, listen, I appreciate your time and insights today, and we'll get together soon as usual.
Yeah.
And thank you very, very much for that.
Thank
Very
you, Jim.
insightful. And like I say, the guys know your book there, know your website. Contact George if you need to know more, or through us, and we'll put you.
I'd be happy to go over somebody's portfolio or look, if they give me a few stocks to look at, but whatever, you know, I'll
Absolutely, George.
I love doing it.
Thank you very much.
Okay, take care.
Take it easy, man.
Bye-bye.
Thank you.
Bye-bye.
Bye-bye. So that was George. We're going to take a break in a couple of minutes, but I mean, you know, you can see the kind of pattern evolving here today. We you know, there's always some sort of edge. You know, that's our name. So when we were born, you know, we're looking for an edge in the market. Buying cheap will get cheaper sometimes. A lot of the times, you know, you book stocks on the way down, market sentiments change, and immediately you're sitting on 10-15% losses for no reason. Well, you know, I always say at the moment, you know, you need an analytical edge, which is, I believe, the cheapness or what you believe is cheap, and it has to be very cheap, in my opinion. But you also need a behavior edge, and that behavior edge means what do you think? What are your biases? You know, you're just thinking Meta are going to go up because it's a big stock and it always goes up, or Tesla are going to go up because it's a big stock and it always goes up. You know, are you just buying them because of that? And then you've got to think of the market bias as well. You know, what does the market think? You know, does everyone think this is going up, or does everyone think it's going down? And I think that if you can take a contrarian view in investing, you're a winner long term. And I think that's come through a lot of the speakers already this morning. You heard David in the way he looks at stocks. You've heard George in the way in contrarian thinking as well, and obviously Paul on the analytical front. So take that in your armory and make sure these things add up, because it's very, very important to win. Otherwise, like I say, you're buying cheap and you're sitting on cheap, and it might get cheaper. And then you're buying on the way down because you think you're forced to have to. And coming up, you'll hear Gary Klein, which is one of the guys I've been trying to get for years, to be honest, will give you the idea of decision making and emotional decision making, because in investing is one of the worst places for emotion, because you can lose a lot of money very quickly, and that will drive your behavior. So that's the thing that's coming up. And we also got Rupal after the break. We're going to take 5 minutes break, 5-6 minutes break. We're going to bring Rupal on. She's very good contrarian investor as well. The first time I've heard her, you're going to learn a lot from her, I guess. I'm looking forward to her. So hopefully you enjoyed the first section of the day, and stay with us. Fill out those questions. You know, this is a chance for you to ask questions of the guests, and get the stuff you really want to know. So fill up that box of questions, and I appreciate you listening so far. But let's take 5 minutes, and we'll be back. Thank you. So welcome back, everybody. You saw the first half. We talked a lot about contrarian investments, and leads us into our next guest, actually, Rupal Bhansali. She is Chief Investment Officer and Portfolio Manager of Ariel's Global Equity Strategies. Manages, I mean, correct me if I'm wrong, 15 billion plus. So looking at all the strategies, she also co-manages the firm's global concentrate strategy. And you might have seen her on Bloomberg and in the press, and I've seen her in Barron's. And you know, let's face it, women leaders in this investment world are few and far between, and it's great to have her on, and I appreciate her giving her time, and I'm looking forward. But I guess Rupal will tell you a little bit more, but her thrust really is looking at things in a different way, continuing the theme of contrarian investing today, and I think, like I say, she can tell you a little bit more about how she does that. But Rupal, hopefully that gives you the overview from my side. She's got a great book out. Even sent me it, and so take a look at that. And like I say, we're looking forward to hearing you today. And please take it away.
Thank you, Jim. It's wonderful to be here and for such a great cause. Congratulations on the fundraising. Happy to support it. As you mentioned, I am a contrarian. I literally wrote the book on non-consensus investing. And I think that the markets are facing a moment where people need to think very differently and unconventionally. So I'm happy to kick it off with this presentation, and then we'll take questions. So I just want to share screen for a quick moment so you can see some of my prepared remarks. Hopefully you can see my screen share.
Yes, we can.
So this presentation is all about how you can think about the regime change, which I think is turning from a party that we've had for the last decade to a hangover. And I know that the latest market movements don't feel that way because markets have been rallying and taking a lot of solace. But I firmly believe that there is a regime change, and it's not so much to do with inflation or the Fed dot plot, which I know is everybody's attention is focused there. It's more to do with QE turning to QT, which is quantitative easing versus quantitative tightening. Now, in a QE world, risk-taking was rewarded. The more risk you took, the more money you made. In a QT world, risk-taking gets penalized. And you saw that in the first half of this year, where loss-making companies, leverage companies, riskier asset classes like equities, the NASDAQ crypto in particular, all correcting. And that's part of the reason why I'm flagging this issue, that risk-taking is something we need to take very, very seriously. And in a non-consensus way, I know a lot of people who think investing is about making returns and you know, what can go right and how much can a stock go up. I believe it's also about risk management, which is thinking about what's the downside, what can go wrong, and how do you avoid those losses. In particular, the asset class or asset classes that benefited a lot during this QE world were things where the business model entailed leverage. You know, as interest rates fell and money was very, very easily available, anything that had leverage as part of its business model, whether it's real estate or private equity, and indeed even equities that borrow a lot of money to invest in other companies at perhaps even inflated valuations, did quite well. But in a QT world, I think one needs to pay much more attention to the debt multiple, not just the earnings multiple, because debt will become the four-letter word that it always should have been. In the past, we were used to a Goldilocks world, which is it was never too hot, not too cold. But in a stagflationary world, which is upon us, I think everything that can go wrong is potentially going wrong from a macroeconomic standpoint. Just when we need fiscal stimulus to help out a recessionary outlook from a monetary withdrawal, we actually have both a fiscal tightening underway as well as a monetary tightening underway. And so it's the worst of all worlds from a corporate profit standpoint. It's not just so much about the economic recession, it's about the profit recession. And inflation tends to eat away at savings, and the consumer tends to be a very strong portion of the economy, both in the US and elsewhere. In most developed markets, inflation cuts away at that. And you're already seeing evidence of that in retail sales, which are starting to disappoint, and companies are flagging that the Christmas season does not look very promising from that standpoint. In the past, the Fed was also supporting Wall Street because after the GFC, it was imperative that animal spirits were restored and we didn't go into a depression or in some sort of recession negativity spiral. But I think that went a step too far, partly because of COVID, which was unexpected, and the escalation and the increase in the Fed balance sheet and the fiscal balance sheets all over the world resulted in a lot of support for Wall Street. But as that is withdrawn, it means that Wall Street is likely to suffer and support is going to be provided to Main Street, which of course is where it should be provided all along. Historically, passive has been the way to go. For the last decade, it was about set it and forget it. And I'm here to tell you that there's a regime change underway where it'll be very important, not just what you put into your portfolios, but what you leave out of it, which means active, which can be opportunistic and disciplined and more agile in what I expect to be a pretty volatile market going forward. So what worked and what is likely to work are very two different things. And so it warrants a repositioning of portfolios. In particular, I mentioned risk-taking was rewarded, and that's why junk bonds did extremely well. But I think that's where the pain is going to get concentrated. On the flip side, this notion that treasuries were absolutely risk, there was no return, and it was return-free risk. Well, now at least they're giving you a return, although of course the risk exists, and one has to be careful as to where one positions within the treasury yield curve. But nonetheless, I think that risk-free assets are going to do better than risky assets in the coming years. In the equity markets, there is something that I label as junk equities, which is characterized by the 4 L's, which are referred to as loss-making companies, leverage companies, companies with lofty valuations and lofty expectations built into them, which some people refer to as growth equities. And I believe if there is a combination of those 3 or 4 characteristics, that's where the pain is concentrated. When you saw the big sell-off in the first half of the year, if you actually parse, not just sectorally or geographically, or even through different indices, you will see that cutting across, whether it's a small cap stock or a large cap one, if it was loss-making or highly leveraged or had very lofty valuations, those came crashing down. And that's kind of caused a lot of pain in people's portfolios. I think that if you buy low-risk equities and you don't overpay for them, that is a way you're going to make money over the next decade, not by taking on a lot of risk. Private equity has been a darling asset class, and of course, one where both illiquidity was not a problem, but as I mentioned to you, liquidity will be a problem going forward because liquidity or lack of liquidity can be a form of risk. And nobody cared about that liquidity risk when risk-taking was rewarded, but I think going forward they will. And leverage is part and parcel of the private equity business model. And as I mentioned, leverage companies or any business model where leverage is implicit or explicit is going to be very challenged in the coming years. On the other hand, hedge funds, which of course have been reviled as opposed to revered in the last decade, and I found it very tough going because shorting was extremely difficult in a speculative frothy market like 2021. It did destroy the track records of many hedge funds out there, but those who know how to do it well, I think are likely to make a comeback. Long short is going to be one way to generate positive returns because shorting opportunities will abound far more than long opportunities. The US has been, again, another darling market, and I'm not trying to be contrarian for the heck of. In the next couple of slides, I will show you why the US looks extremely exposed and vulnerable from a derating perspective. And on the other hand, Europe, which has seen a lot of negativity, partly because of the Ukraine conflict, partly because Europe has never grown to its full potential, and emerging markets, of course, being the worst performing asset class within equities of the last decade. But a lot of the bad news or the risks that we are exposed to and negativity is, in my opinion, already in the price. And when you're paid to take risk, you should take it. It's when you're not paid to take it that you should be afraid of it. And so I'll talk a little bit more specifically about these opportunities in the coming slides, but I wanted to give you a big picture understanding of how I think portfolios should be repositioned going forward. And of course, we all know that speculation, and I'm going to call them loon shots, were the way to go in order to make money. A lot of IPOs of companies with ridiculously lofty expectations, got issued, and unfortunately, they're coming crashing down. And I call them loon shots because people expected them to be moonshots, but they turned out to be the opposite. On the other hand, classical old school investment strategies like dividend paying strategies are likely to do quite well. You don't need to believe a lot in order for these companies to do well. They might be just singles and doubles, but again, slow and steady will probably win the race as we look ahead. And then passive growth and thematic, top-down investing has worked quite well. And I think the opposite is likely in the coming years. Active, value, and idiosyncratic. Now, I would remind you that most portfolios, as I talk to institutional investors out there all over the world, they're positioned pretty much in areas of the market which have already worked. And I suspect that as they look at their asset allocation, as they look at the outlook ahead, sometime in 2023, people are likely to start thinking about repositioning more materially than they have so far. And investors like us might be well served to be ahead of that rather than behind the curve. So I mentioned to you that I will discuss, the valuations of the US market and why I think the US is particularly exposed to a correction. And that's to do with the historical valuations. The Shiller P/E ratio on the S&P 500 is still squarely at the upper end of where it has traded for the last 30, 40 years. And despite this correction that occurred, this is as of September 30th, you can see that they are very elevated multiples. And I suspect that 2023 earnings are still very high relative to what will materialize. So this P/E multiple is even more exposed than meets the eye. You then look at the valuations of emerging markets versus the US market. And what you find is that emerging markets are squarely trading well below their historical averages. And the only exceptions of trading well above historical averages are the US and India. Of course, India is an emerging market, and my comment was not to pick, the entire asset class, but to curate a portfolio. But generally speaking, value tends to cluster. And certainly value seems to be clustering in emerging markets, as a lot of the risks that people were concerned about, whether it's political risk in China or in Brazil, a lot of these are coming to fruition. And one thing that we all know about investing is when it's a crowded trade, it tends to be unprofitable over time. But the lonely trade, the one that few people dare or care to make, typically tends to result in far better returns for the risk that you're exposed to. And I do believe that emerging markets, that's where we find ourselves today. The currency can play a very important role in dollar returns for dollar investors, but also for international investors. And the US dollar has been a very significant contributor to returns, which is a very big anomaly. Historically, the dollar has been a devaluing or a depreciating currency, because in the long run, countries which have a current account deficit tend to have a weaker currency. And the US and the UK, for example, are countries that routinely run current account deficits, and they need foreign direct investment to make up for the difference. And historically, people have invested in US treasuries, they've invested in the US stock market, and it's pretty rare that you make good money on both the underlying asset class and on the currency. Typically, it's the other way around. You give some up on the currency. But because both of these have contributed to returns, people have been lulled into, I think, a complacency that this will always be the case. And I actually think that the US dollar is more likely to depreciate from here on rather than appreciate, which means it's going to detract from returns rather than contributing. And I just wanted to put currencies into perspective. Calling currencies in the short run is a fool's errand, and I'm not trying to do so here. But when you look at 100 years of history, what you find is that countries that had currency hegemonies tend to last about 110 years at the upper end, and often only last about 80 years. And you can see that whether it's the Portuguese currency, it's the Dutch guilder, it's the French franc, or it's the UK pound sterling, we've all come through those sorts of hegemonies. And this century, of course, has been the US dollar hegemony, but we are up on the 102nd year, and I'm not sure that this is going to last forever. So again, something to be mindful of in terms of dollarized returns. I mentioned that dividends can cushion the blow, and I wanted to support that statement by reminding people that we can actually have a lost decade in markets. We've not had one for a long time, and so it's easy to forget. But between 2001 and 2010, the markets were down roughly 5%, but dividends helped to cushion the blow, where you ended up at least having a positive return on your portfolio rather than a negative one. But you look at another decade, whether it's 69 to 78, and whether you look at international markets between 2008 and 2017, again, in all these instances, you find that if you had a dividend yielding portfolio and you reinvested it and the dividends got paid, you actually ended up higher rather than lower. Given the very high valuations of the markets all over the world, and this is true of developed markets abroad as well as in the US, I believe that dividends are going to be a very instrumental portion of the portfolio to cushion the blow. I also wanted to share how EM is trading, emerging markets are trading relative to both their history, as well as put that in perspective. We saw how the US market was trading closer to its highs than its lows, and the opposite is true for the emerging markets. at significant, at least a 1 standard deviation, below their averages, not quite there, but almost getting there. And so it's important to get ready to participate, if the opportunity presents itself. But it's pretty clear that at least the risk reward is looking far more attractive than it used to. And the other advantage, of course, is that emerging market currencies, which do expose us to a lot of risk, that risk has already materialized to a large extent. You find that over the last several years, no matter which period you look at, the currencies, whether it's the Chinese yuan, whether it's the Taiwanese dollar, whether it's the Indian rupee, the South Korean won, these are all large exposures within the emerging market indices. They have fallen somewhere between 25 to 35%, if not more. And again, when currencies already fall, they tend to fall less because of the base effects. And so I think that all these emerging market currencies having materially underperformed the dollar basket, there is a very high probability of it reversing. In fact, that's already started to happen this year. In case you didn't notice, Brazil is one of the best performing markets, both in terms of the underlying index as well as the currency. And this is at a time when most major indices all over the world have actually fallen. To find an index that goes up, that speaks to how a contrarian trade can actually, an uncorrelated trade can make a lot of sense in a portfolio in this regime change that I think is underway. So I think I've made my high level remarks, and I just wanted to also underscore how emerging markets as indices have dramatically underperformed the S&P 500 as well as international developed markets. And so that would be my big sort of contrarian call to try to look elsewhere in markets that are driven and characterized by a lot of pessimism and negativity. I am absolutely aware of all the risks that emerging markets expose us to. I used to call out these risks, a decade ago when people thought emerging markets should be overweighted. I had the opposite view. I was very underweight. And for the first time in a long time, I have not found value in emerging markets. Not that I'm a top-down investor, but a lot of my incremental new idea generation came from these emerging markets. And I thought I would flag that as a contrarian opportunity. So with that, I'm going to take questions. And Jim, I'll turn it back to you.
Fantastic, Rupal. That was great insight. I love the contrarian view and also the comparison between then and what you think is going to happen. I love that. I guess, I had a couple of questions as some come in that just, but I want to ask a couple. Now, I'm not a big macro fan. Everybody knows that, right? I don't really get it. I don't, as things change so quickly. And I think for the regular investor, and maybe a lot of people, you're kind of swayed sometimes by the fact that this is a good company, it's a good stock, and you get this wave of bad news in the background. I mean, how much should, I guess, an investor or yourself really factor in that macro implication of a stock? Because, you ask Buffett, he's going to say, oh, I don't care about, macro, I'm in it for the long term. So, you got that view and your view where you put a lot of the macro ideas in there. So I guess, that's the question really. I mean, how much emphasis should an investor really put on the macro implication right now as opposed to the actual company dynamics?
Jim, excellent point. I'm very much a bottoms-up stock picker and have a lot of sympathy for people who believe in doing bottoms-up fundamental research. That's what I do for a living. But I think this regime change that is underway has a lot of geopolitical implications. And to me, ultimately, a good investor thinks about risks, not just returns. And going forward, the risk is going to be far more macroeconomic. It's going to be far more led by externalities of the sort that we're not currently thinking about with respect to stock markets. And when there is a regime change where that factor is going to overwhelm a lot of other underlying individual micro developments in companies, it behooves us as investors, as fiduciaries, to pay attention to all of it. In the US, generally speaking, during Warren Buffett's time in the markets, it's been an upward trending development when it comes to economic outlook. The bond markets have done very well. We went from a period of interest rates being in the 17 or high teens to being practically zero. So all the macroeconomic backdrops, generally speaking, over the long run, were positive. And they were additive to your stock picking selection decisions. But if they are going to hurt them, and remember, I'm talking about investing abroad because incrementally, that's where I think the better quality companies at more undervalued levels, higher dividend yields are available. To ignore the macro would be a mistake. And I cover 50 countries around the world. I can tell you that if you invest in Japan, if you invest in France, if you invest in Germany, if you invest in China, Brazil, if you don't pay attention, the UK, as we see what's going on right now in terms of the politics and the bond markets, I think that you will have a blind spot in investing. So what might be true of US investing is not necessarily true of international investing. And that's why I wanted to call it out, because as a contrarian, my attention is focused on what are the blind spots? What's the thing that's going to come back to haunt? And that's why I'm flagging it. But make no mistake about it, I am at heart and in practice, a bottoms-up stock picker.
Okay, thank you for that. And so my second question, I've got a couple coming in. I just want to answer this one as well. Now, we're very catalyst driven, right? We've had lots of people on today, insiders, what the management doing, and I think in this sort of market, there's really, it boils down to there's two ways you can buy. It's certainly dirt cheap, cave your head in 2020 March, whatever that capitulation stage is. Or there's some sort of catalyst event on the horizon. Now, we deal in spinoffs, we look at stuff like that, which natural value creation strategy. So do you look for any catalyst events in your investments? Because as we've seen, stocks can stay cheap. And I said earlier, in 2001, the S&P took 12 years to get back to its level. You're buying the market, you're sitting on that one. 2008, the same thing, took 4 years. So, if you're that sort of inclined, you could be sitting on that. And as you well know, in this environment, sentiment changes on a sixpence, and next thing you know, your cheap stock just got exceptionally cheaper. So are you looking for any sort of catalyst, or is that involved in any of your stock picking? Do you even look at that sort of stuff in terms of in terms of the stocks you or companies you look at?
So Jim, a great question. I think that value can be its own catalyst. And I define value as investing with a margin of safety, not cheap for the sake of cheap. I actually don't believe in doing that at all, which is, I think, where a lot of investors get into trouble, because as you mentioned, cheap stocks can get cheaper because frankly, the cheapness was an optical illusion. What I would argue is that if you invest in a company that compounds its value over time in its own business, you don't need the stock market to recognize it right away because the underlying business is accreting, and good businesses would generate free cash flows and can return that free cash flow to shareholders in the form of steady dividends. Well, you're getting paid as you wait. And that's the beauty of it. A bird in hand is worth more than two in the bush. And I think a lot of people think that you can sprint your way into a marathon. You really can't. Investing is a marathon, and trying to make money very quickly sometimes actually results in losing money very quickly. Speed is not the barometer of quality or of an ability to make money. But I would argue that if you have dividends that are getting paid like clockwork, you actually don't have to worry about the capital appreciation. It almost takes care of itself.
I think that's a great point, and it actually backs up. Recently I put some money in, about 25% of the portfolio in the ETF VIG, which is a high dividend payer, and I think that a cheap name on the high dividends are, like I say, going to pay you back. So here's a couple more questions that come through. They're slightly macro, but maybe you can be able to answer them, and I'm not sure. But one of them is, do you have any thoughts on gold?
Unfortunately, no. I think that gold is a very eclectic and unique asset class, and I think a lot of people assume that it plays a role in a certain way and invests accordingly, and then it befuddles you because it does not play that role, and it often does the opposite of what you think it should do, based on history or based on classical theory. So I'm afraid I think it's a very, very esoteric and eclectic asset class. And one that is seen as a hedge, but generally speaking, I find other avenues to hedge my portfolio rather than use gold. So historically, I have not invested in gold in my portfolios. So I'm afraid I'm not quite sure what role it can play in other people's portfolio. It's a very unique, very esoteric, very eclectic asset class. You really need to know what you're doing and what role it plays.
Absolutely, I'm with you on that. I don't know anything about gold either. But great answer.
Better to acknowledge what you don't know than to invest in something, assuming you know.
All right, so got a couple more questions here. You any sector preferences for regime change? Small cap, large cap, mid cap, anywhere, any particular sweet spots there? I mean, you know, I spoke to a lot of people and they're like, well, you know what? Facebook's a great stock. You know, Google's always going to be a great stock, and I think I'm with you. You know, they could stay cheap for a while. So I don't know whether they're your picks or whatever. But on this regime change you're talking about, is there any sweet spots within that investors should be looking at?
Absolutely. So I think, you know, talking about these market favorites, the FANGs, so to speak, I was never a fan of the FANGs. And so I think that those were very crowded trades. And in fact, the biggest risk that people didn't realize in those stocks was competition risk. And TikTok comes along and they take eyeballs away. And people don't realize that instead of having high barriers to entry and a winner-take-all business model, a lot of these businesses were simply advertising-led business models. And advertising prices are nothing but a commodity. Demand for advertising versus supply of advertising. And when TikTok comes along and takes over the demand because, you know, eyeballs are going there and increases ad supply, well, ad prices crash. And then the moment, you know, Apple changes its privacy rule, again, it takes some demand away. And so I'm just pointing out that a lot of people think that these companies are highly differentiated, whereas advertising is nothing but other than another commodity, and people didn't think of it that way. So there's a lot of misunderstanding in the markets about quality. But you asked about where am I finding opportunity, which is really the right question. You know, across the spectrum, I talked about dividend yielding stocks, which are resilient. And a litmus test for that can be the companies that paid dividends in 2020, you know, during COVID. You can bet that those dividends are pretty resilient because that was a pretty tough time. And it was easy if you wanted to cut your dividends to just cut them, frankly. And so if you paid them, that's a good litmus test to check against. But I don't think it's about small cap, large cap, mid cap, or mega caps at all. Sectorally, I do think there is opportunity in healthcare. But I'm talking traditional healthcare, you know, not the sort of single product sort of biotech, binary biotech. I'm talking about established companies. A lot of them happen to be in Switzerland. They have the combination of having a good pipeline, you know, having good prospects, established products in the market, established capabilities, not one-trick ponies. I'm thinking here, you know, companies like a Roche, a Novartis, a Sanofi, and they also have good dividend yields to boot. And I think that healthcare is a sector that is going to see secular demand, unfortunately, and growing demand. And I think that recession or no recession, you know, whether there is a fiscal deficit or a current account deficit, these companies tend to be agnostic about the economic or external environment. And generally speaking, a lot of the risks that people think about in the sector, which is, you know, pricing pressures, they're already in the price. And that's what I like about them, that yes, they are exposed to risks, but people know them. And that's why the sector trades where it does. Now, I would actually call out stocks in the US as well, even though I'm negative on the US, there are some opportunities such as, you know, Gilead, such as Bristol Myers Squibb, and already in the international markets, I mentioned a few names. All of these, again, come with reasonably good balance sheets, reasonably good dividend yields, and are undervalued such that you can even get capital appreciation.
I think, yeah, I think that's some great points. And on your first point on the FANGs, I think, you know, it's come to the stage where, you know, it might have even gone full circle, where there's a breakup value in some of those a lot higher, and they might be forced to break up just because, you know, they've accumulated so many stocks. Let's take Facebook or Meta, for example, and the breakup value is a lot higher. So whether they can stay the same over time remains to be seen. But, you know, you got Amazon Cloud, you got the pricing service, you got all that. So there's a lot of breakup value in that. Is the first thing. And on the healthcare, I agree with you. I think that one thing extra to what you said is there's a lot of R&D going into the healthcare, and I think naturally they're going to find maybe different cures or different things that come out of that. So yeah, I agree with you with that, and I appreciate your insight. So I think that's it for today. And I know you're super busy, and like I say, I've got a lot out of you today myself. I'm sure the audience did, but hope you enjoyed speaking. We enjoyed you, and I appreciate your support on that. And yeah, we'll let you go. And
thank you, Jim.
Was there anything else you wanted to say while you're here?
No, I think thanks for supporting a great cause. Happy to be of help in that regard.
Thank you.
And I hope your investors don't misconstrue a lot of my top-down comments. I only flagged them as much as I did because I think it's going to be a blind spot for markets. And my
Yeah.
job is to educate people on what they're missing, not what is staring in front of their faces. So
Fantastic.
thank
Fantastic.
you. For the
Great
opportunity.
insights. Thank you, Rupal. Thank you. Bye-bye. Okay, so got a lot out of that personally. Hope you did as well. We've got a little bit of something different next, actually. I talk a lot about behavior, and I'm talking more and more about that. You can have a look. I mentioned my Forbes blog earlier. Take a look at that. But within that, I talk a lot about behavioral biases, because, when it comes to market, people say to you, or stock says, it's a great stock. It's fantastic. Well, it's Facebook, isn't it? It's Amazon, isn't it? They're always going to make money. Well, is that your behavioral bias talking, or is that genuine value in there? Like Rupal says, the misconception of value is a real problem with investors. So, like I say, I talk a lot about behavior, and I mentioned before the analytical edge, which is things that are cheap, your perception of cheap, the way you look at cheap, but also your behavioral biases. And the behavioral bias come into what you think, but also what the market thinks as well. If everyone thinks something's the wrong price and it's going down, you work on the basis that the majority are always wrong. You might get more right than wrong. So keep that in your analysis. And I really push that in some of the articles if you read, and as well as all these guys got the book. Hopefully my books are available next year as well, but it talks a lot about that as well. Really pushing behavioral biases, because we all know most people are smart enough to know what's cheap, how they perceive it. But that comes to a point where cheap is cheap. And if everyone thinks everything's cheap, or one stock's cheap, it probably isn't cheap. It's probably going to go one way. And we're seeing that in the case of things like MSGE, IAC, the stocks like that, where everyone says, well, you know how much value it's got in it? Did you know? Well, we did know, and we own it, and it went the other way. So contrarian, what you're hearing today is the overall theme. And our next guest is just the forefront, really, of decision-making and behavioral, I wouldn't say behavioral economics, you can tell a little bit more, but decision making, and we know decision making when you're losing money is a horrible feeling, because you have to make that decision without seeing the red on the screen, and that's very, very difficult. So and I was always a big fan of trade risk, not P&L, and if you can do that, and it's very, very hard, then you can get over a lot of it. But our next guest, Gary Klein, has been around for a long, long time and really pioneered cognitive science in terms of decision making and why people make decisions. And I've been trying to get him for a few years now, and I'm so pleased that he's come on. If you've never read any of these books, go get them. It's The Power of Intuition. It's Seeing What Others Don't. There's a couple more out there which I read and I just can't remember offhand. They remind you. And also the latest one, Snapshots of the Mind. And it's just a real insight into the ways you'll make decisions. And I'm a big one on personality tests, and why people are good or not good at things, including myself. So I want to bring him in if he's there. Gary, are you with us?
Yes, I am.
There he is. Fantastic. And it's such a pleasure to have you here. I know you're super busy and you're in demand, but you're the man in this field. And like I say, we got a host of investors on board, and like I say, it's the worst, I guess, the worst industry for making decisions when you're losing money, and also when you're making money. People have a habit of snatching profits quick and letting their losses run, and that's what the investment world has always been. They're right, so they want to wait till they're right. They get a profit, they want to take it quick. That's the way investors are. So hopefully you can shed some light on why people do that and why people make decisions. But super pleased to have you. And like I say, go you push on with what you got to tell us.
Okay, thank you very much, Jim, for inviting me to talk to this group. I'm not an investment specialist. I'm a cognitive psychologist, and I've studied decision-making for several decades. And I'm simply going to describe what we've learned about how people actually make decisions, which it may not be what you've been expecting. So I'm going to share my screen, or try to share my screen. Can you see my slides?
We see it. Thank you.
Okay, excellent. So I'm going to be talking about how people actually make decisions and the role of intuition in decision making. So let's talk about the conventional views of how people are supposed to make decisions. And we're supposed to be rational. And if you want to make a decision, you've got a few options, call them A, B, and C. And which one are you going to pick? And you set up your evaluation dimensions so you can assess each of the options on each of the dimension. And as I do fill out this matrix, option A comes out ahead. So that's what I'm supposed to pick. And that's how we all make decisions, right? Well, you know that that's not how we actually make decisions. So what's wrong with this picture? Well, it takes a lot of time to set up this matrix. But it also takes a lot of data, and you may not be totally sure what gets a tick mark and what doesn't. And there may be ambiguity about that. I know of only one study that required people to use this type of a matrix approach as opposed to just relying on their own judgment, their own experience. And that study found a significant difference. But it was in the opposite direction of what people expected. Those who were required to use this type of matrix to make decisions, the result was worse performance, not better performance. The Army is interested in decision making, obviously, and spent a lot of money building training or decision aids to help people use this type of matrix approach or other kinds of decision tree approaches, and found that there was little value, and that was frustrating to them. And we also know that we game the method. So here, option A came out ahead, but what if in your heart you really wanted option C to come out ahead? Do you say, too bad, I've got to go with option A? We don't do that. We say, maybe option C should have gotten a tick mark on the first evaluation dimension. So probably I should pencil one in for that. And maybe there's evaluation dimension 5 that I hadn't thought of. That's the real reason I like option C. And it's the only one that gets a tick mark there. And we keep juggling it until it comes out the way we want. And then we think we've made a rational decision, but we haven't. So if we're not using this type of a matrix very often, sometimes we do use something like this, but generally we don't. What are we using? And a lot of people say, well, I just rely on intuition. And that makes a number of us shudder, because what do we think about intuition? When we think about intuition, it's got all these strange connotations. It's like looking in a crystal ball, or pyramid power, or tarot cards, or Luke Skywalker getting in touch. So that's not something we want to rely on for important decisions. But I think there's another way to look at intuition, not as something occult, not as something magical, but as an outgrowth of experience. And the kind of experience that we've learned is underlying intuition is not from explicit knowledge. Declarative information is factual information or routines. It's really what's underneath the surface. It's tacit knowledge that we've built up through experience. And that's how experience comes to play. So we're able to draw on our experience to recognize patterns, and to make the perceptual discriminations and other kinds of discriminations that others with less experience can't make. And the mental models that we've grown, and the way we judge typicality based on our experience, because then if something odd comes up, we notice it, so we can notice anomalies and the mindsets that we've built up. So these all feel may feel occult because they're not the product of rational, deliberate, conscious processes, but they're no less important. They reflect the experience that we've had that are giving us suggestions and guidelines about what we're supposed to do. That's the claim, that's the finding we made. Well, let me tell you what's behind that finding. Our first study was in 1985, and the Army wanted to fund us to understand how people actually make decisions. And instead of taking a simple decision task like you would in a college environment where it's an artificial task and you have college students performing it, we said, let's talk to some people who actually have to make decisions, life and death decisions under uncertainty and time pressure. And we decided to study firefighters. And we studied experts. In our first project, they had an average of 23 years of experience. And we didn't just study the easy events, we studied the tough cases. So this was a natural task that was dynamic. It kept changing from the beginning to the end. There was lots of time pressure. And almost 80% of the cases in this first study, the decision was made in less than a minute. And the consequences were real. And as we interviewed them and rode with them, we slept in fire stations, we went to scenes of fires. And I remember the first firefighter I interviewed, and I said, I'm here to study how you make decisions. And he said, let me stop you right there. I've been a firefighter for 16 years. I've been a captain for 12 years. And all that time, I don't think I've ever made a single decision. And my heart sank because he was the first one I interviewed. And we had just gotten funded from the Army. And I thought, this project is going to be a disaster. And I said, well, how do you know what to do? And he said, it's just procedures. You just follow the procedures. So my mind was spinning, and I said, can I see the procedure manual? Because maybe there was something in the procedure manual I could use. And he said, oh, it's not written down. You just know. And I thought, okay, so something strange is going on here, but we have two puzzles. Because he's telling me that he goes with the first option he thinks of. How could he be confident that that's a good option? And how can he even evaluate an option without comparing it to others to see which is best? And we studied 26 of the firefighters. We conducted interviews with 26, and as well as drew on our observations. And here's what we found. We developed a recognition primed model of decision making. And it has three components. On the left is a simple match. What happens if there's lots of time pressure and you experience the situation and you recognize here's what's going on. And by recognizing it, you know what kind of goals to try to achieve. You know what the cues are that you should be paying attention to. You know what to expect so that you're ready as it unfolds. And you know the kinds of actions that are likely to be successful, and you just implement the top of the list. That's how they're able to make rapid decisions, life and death decisions under time pressure. It's not looking in a crystal ball, it's drawing on over 20 years of experience, 15, 20 years of experience or more. But in most cases, you do have some time. So you're not simply implementing the first action in your set of options. You consider that option and you mentally simulate it. Is this going to work in this situation? You imagine it playing out in this situation, and if it works in your imagination, then you implement it. If it almost works, then you say, is there a way I can improve it so I can overcome the problems? And if you still don't think it'll work, then you go down to the next option until you find one that you believe will be effective. And so you're deliberating about the possibilities. So now we've solved our two mysteries. The first is, how can they be confident that the first option they think of is usually going to work? Because they draw on their experience and the patterns that they've built up. And then how can they evaluate an option without comparing it to the others? And the answer is they evaluate it by imagining it, not by comparing it. Now, in more complex situations on the right, what happens here is you may not get an immediate pattern match. You're not sure what's going on in the situation. And then you've got to maybe get more information. Maybe you've got to reassess the situation, try to find a way to reframe it. Maybe you're building a story to see if you can account for what you're observing. And then you're judging the story based on how plausible it is. And once you have a reasonably plausible story, then you can draw on your experience and keep going and proceed. So this is a recognition prime decision model. The features of this model, it's a blend of intuition and analysis. The intuition is the pattern recognition part, where you're using your experience to rapidly size up what's going on. The analysis part is not by setting up a matrix or a decision tree, it's by mental simulation, by imagining what would happen if you implement this action in this situation. Another feature is that in most cases, and we have data that we've published about this, in most cases, the first option you think of is usually workable. So you're not randomly generating options. You're using your experience, your intuition to generate options that are plausible and reasonable. A third feature is that this is about satisficing. Optimizing means trying to find out the best possible option. And in most complex situations with lots of ambiguity, it's not clear what's the best. Instead, you want the option that's going to work. And that's what satisficing is about. Herbert Simon, who won a Nobel Prize, came up with the concept. A fourth feature is that you're evaluating through this mental simulation process, not by setting up a matrix or a decision tree. The fifth feature is you're trying to improve options. If the mental simulation shows you flaws in the option, you don't say, I'm stuck. You might say, I can overcome that flaw. I can modify the option to come up with something even better. And the sixth feature is most of the work here is on situation awareness. It's usually obvious what course of action to choose once you know what's going on in this situation. So that's what is the emphasis, how you size up situations. And then finally, this is a model that shows how decision makers can be primed to act, and they're not paralyzed by analysis. They're not waiting to complete their analyses. Do we have any data to support this? There are lots of studies that have supported this model. There's lots of replications. At the bottom are other people in other situations that have replicated it. Electronic warfare technicians, that's Josephine Randall. 93% of the people she studied used a recognition prime decision strategy. British Army officers, Ralph Pasquale, Simon Henderson in the UK, 87%. British offshore oil installation managers, Rona Flynn in Aberdeen, Scotland, 90%. U.S. Navy Command and Control, Susan Hakovar in San Diego, 89%. Above the line are replications we conducted with battle managers and Aegis Navy commanders getting 96% and 95% RPD. In our first study with urban fireground commanders, it was 80%. Now, you might look at the design engineers. It was only 60% of them. How come? We wanted to study design engineers because they weren't under that much time pressure. And still, the majority of their decisions were recognition prime decisions. But even when they weren't using recognition prime decisions, they were using analogs or other methods. They weren't setting up a matrix or a decision tree. What about the tank platoon leaders? What about them? There was only 42%. Deliberately, we went to Fort Knox to study people who had just started their tank training. They had never been in a tank before. We rode with them in the loader seat. I rode around with them, so did my colleagues. Some of them were from the Southwest. They'd never been in a forest before. So they were less likely, they had no experience base. They were less likely to use a recognition strategy. They were debating between options. It didn't help them. They still made terrible decisions. Okay, so how do you develop effective intuition? This was a project I did with Danny Kahneman. We published it in 2009. Kahneman wrote Thinking Fast and Slow. He also won his own Nobel Prize. And we found that for effective intuition to work, it has to be a reasonably predictable world. It can't be chaotic. It can't be random. And there has to be an opportunity for practice to build up the patterns that you're going to rely on and to get feedback on your decisions so you can learn and improve your patterns. Now, what can you do to improve your experience rather than taking 10 years or 10,000 trials? We've developed a method called Shadowbox to try to speed up the development of expertise and decision-making. And one problem is it's hard to get subject matter experts to be trainers. And so we're trying to avoid the major expense of subject matter experts. And what we do is we present a challenging scenario and we insert decision points, which might be multiple choice options about what responses would you pick, what priorities would you set up, what information would you track. And the people who are being trained rank the alternatives and write down why they ranked them that way, what's their rationale. And then we've had a small panel of maybe 3 or 5 experts go through the same scenario, done their ranking, written down their rationale, and we show the trainees, here's what the experts ranked. But also, more important, here's the reasons. And then the trainees get to see how the experts were viewing the situation. So they're seeing the world through the eyes of the experts. And experts don't have to be there, so you've avoided that bottleneck. And the evaluation studies that we've done show that even after just a half a day of training, there's an 18 to 27% improvement. And Shadowbox works at paper and pencil version, on a desktop version, can use text, audio, visual, interactive video, and so forth. And before I turn it over to questions, I wanted to just repeat what Jim mentioned. My newest book, Snapshots of the Mind, just came out. And if you're interested in learning more about the work that I've done and the naturalistic decision-making approach, you might like to take a look at this book. And now I'll turn it back over to questions.
Thank you, Gary. That was very, very insightful. I could talk to you all day, and you know that. But I had a question myself. And we've spoken before, but just for the benefit of the audience, I've always sort of had good intuition, and I think my mother had it and kind of passed it down. But I guess, it doesn't feel like, it feels like a lot of people, when they say, well, it doesn't feel right, or I think so, or, let's go for it, or, that sort of terminology. Everybody has intuition, but I guess the question really would be, does everybody, maybe a stupid question, does everybody have it to the same extent? Is it just got to be harnessed, or do you think that, maybe some people don't have it? Maybe some people are just born to be, I don't know, maybe programmers and not use their intuition too much. Or I don't know. What is it? You tell me. Does everybody have this gift? Should they all be using it and relying on their feeling to make decisions?
Excellent question. So I don't believe that we are born with good intuition or not good intuition. I think intuition is a product of the experiences we have, the feedback that we get, and the lessons we take away. In the firefighting community, when I wanted to study the experts, they said, do you want to study the people with the most experience or the best people? And I said, what do you mean? And they said, we have some people here who have had 10 years of experience, but they really haven't learned that much. It's like 1 year repeated 10 times when they haven't made any progress. So there are people who are just able to develop meaningful and effective intuition. What there is a difference in is how much people listen to their intuition. And some people, like programmers, many kinds of engineers, are just uncomfortable even listening to their intuition. And so they don't use the lessons from their intuition. Now, I don't want people to think that intuition is perfect. And sometimes I'm asked, when can you trust your intuition? The answer is never. You can never trust your intuition because it could be wrong. But you can't trust the matrix or the decision trees. Those can be wrong as well. So just because you have an intuition doesn't mean it's going to be right. But what you need to do is listen to it and see what it's telling you, especially if you feel that old spidey sense. If you feel that something is wrong, don't ignore that. That might be an important clue.
I love that, and I use that a lot. And you know, like you say, it sounds almost stupid. It sounds like you're in, you know, use the force, Luke. And you know, it's like, well, you know, maybe there's some truth in that, and there definitely is for me. But to explaining that to people can be a difficult one, especially like me. Well, you know, I'm an ISTJ, and as you well know, I rely heavily on facts. So I'm not the engineering type, but I rely on heavily facts. Like, prove it to me, show me the evidence. But then I got my spidey sense the other side saying, well, you know what, we should go here. So, you know, you got that kind of weighing up, which can be a challenge. But that was something I wanted to mention. We had a question come in. We said, can RPD work in investing, given it can be chaotic and a random industry?
Right. So that's something that I've been wondering about as well. And I think where it works best is when you're looking at the evidence and using your experience to appraise how good is the evidence and how are the data collected. Because when I've studied people in the investment community, some of them are just much more skillful and effective at sussing out what counts as reliable evidence and what doesn't. And another area where I think expertise develops is in assessing companies and assessing the fundamentals that companies are demonstrating, and being able to look at the data and look beyond the data to say, this doesn't feel quite right to me. There's something wrong here, and I've got to look into it more deeply. So I think there are ways that RPD can work in the investment world.
Yeah, absolutely agree. We had a couple of people on today, one looking at the behavior of management when they're buying stock and selling stock. And, you know, it's a very emotional driven, you know, part of the market, and contrarian investing, very contrarian views today across the board. So it's been, it's in sync. So I guess that wraps it up for us today. I know you're super busy. I had one more question for you. What's your favorite stock? What do we need to buy today?
Yeah, so I'm going to draw on my experience to deflect that question.
Come on, you must have a favorite company. You got to tell us. I'm going to press you. We're all waiting to buy it. What is it? And if it goes down, we're coming back.
No, I refuse to answer that question.
Okay, actually, one more coming. Do you have a method for when to change your mind? You know, just is it you know, you're thinking something, your intuition's there, your facts there, but maybe something will come up, there'll be a red flag. Is there any point at that, you know, are there any that stage where you go, you know what, no, don't do it? Is there anything like that?
Okay, so in the research that we've done, we find that there are times when people are able to change their mind. And what they're doing is they've got two different viewpoints about what's going on. And they have different kinds of evidence supporting each viewpoint, as well as some evidence arguing against each one of those assessments. And so let's say you believe it's option A or interpretation A is right, and you have contrary evidence. What do? We explain it away. And we can look at how much effort it takes to explain away contrary evidence. And we look at assessment B and what are the contrary data and how easy is it to explain that away. And you can compare the cognitive strain of explaining away the contrary evidence. And that will be a guide as to which one is likely to be the more accurate one.
Fantastic. That's a great piece of advice. All right, so we're going to end it there. I want to reiterate Gary's book here, Snapshot of the Minds. I'm getting through this one. I mean, I've read all these other ones. The Power of Intuition turned me, just enlightened me, really. I mean, go and buy that if you buy anything, and learn about how your mind works, really, to make better decisions, because it's incredible. You use your intuition, and you'll be head and shoulders. You'll have an edge, certainly in the investing world, I believe. Couple that with your analytics, and you got a very powerful formula. So I appreciate you coming today. I know you're busy. Thank you very, very much. Got great insights from you there. I'll be in touch with you shortly, and hopefully the audience got a load out. I know I did. But thank you very much, Gary.
Thank you for inviting me. I appreciate it. Take care.
Cheers, sir. Bye-bye. So that was Gary. I hope you got a lot out of that. I mean, incredible, really. Like I say, go buy those books and learn and gain an edge above everyone else, because the behavioral side of investing is, especially when markets are down, losing money, you're on loss-making positions, is an incredible, powerful force that could make or break, really, investments for the future. So take that away. We're going to take a break for 5 minutes. We're going to come back at let's say quarter past 11 ET, and it's now 10 past, and we've got our findings of our study, and we have looked at 22 years of data in the Spinoff field. If not clear what we do, we look at events that move price to value, and one of those events that we look at are spinoffs and breakups. And frequently, in a breakup, what you get is of some sort of value creation, or maybe there's not. And we looked at the data in terms of all 22 years, brought it right up to date. Just releasing the study to clients yesterday, and we're releasing the results to you today on the main findings. Jonathan Morgan, our deals analyst, will come on, but he's got some real insights into where you should look at these situations, because we'll have Joel Greenblatt up next as well, post John. And Joel wrote that very interesting book, You Too Can Be a Stock Market Genius. And it's really all about spin-offs. And Joel will be on later after John. But, it's an area where if you're looking at contrarian investing, you should be looking in that space. He said, previous conference, he said, you know what, not all spin-offs make money, but X marks the spot if you're looking for the gold. And you should be looking at spin-offs for the gold. So we'll take a few minutes, come back at quarter past, and like I say, excited for John present his findings, and you'll love what he finds, and hopefully you enjoyed it so far. Get your questions in. Get your questions in that little box down the bottom. Whatever it is, we'll endeavour to answer. It's a chance to question us of what we do, how we do it, and your question to get an edge in your investing armory. But 5 minutes, and we'll be back quarter past. Thank you.
All right, perfect. Well, again, good morning, everyone. For those who don't know me, my name is Jonathan Morgan. JP Morgan, the real JP Morgan. And I also just wanted to echo Jim's appreciation to everyone who signed up for our 6th annual conference. And this is our 3rd webinar to help support with this worthy cause. It's not sharing? No? Let's see. All right, let's see. Share screen. right, this should be doing something now. All right, here we go. Great. All right, now we make it big. All right, here we go. We're back again. Back again. So yeah, so great to have everyone on board. Just going to minimize this at the top. Great. Yes. So just again, wanted to echo Jim's appreciation for everyone helping to help raise and donate to this worthy cause, as well as to gain some access to some unique ideas and insight into the space, the spin-off space. So as the senior global deals analyst here at the group, my role is to speak to all of our clients on a weekly, bi-weekly, some just even once a month, or when there's something exciting to speak on in terms of ideas coming up. I also work with the team very closely on the idea generation side of things. And then, of course, looking for the data around spinoffs. So we also look for new activist ideas that fit the criteria of some of our activist clients are on the distribution. So that's pretty much my role in a nutshell. And yeah, I mean, this is now my 6th time presenting at our annual fundraiser investment conference. So I must be doing something right on that back end. But today, what I thought I'd do is I'll speak, as Jim mentioned, to our recent spin-off study that we just released, our spin-off manual, as we're calling it. And I want to speak to its findings, some interesting key findings around the data, and how we're looking to apply that for the best opportunities, and even what to stay away from coming up in the market. So you probably have been seeing the news. There's been a lot of newly announced spin-offs. Even in the last 4 weeks, we've had 4 or 5 new announcements in the market. And the trend we're seeing at the moment is that, yes, the spin-off calendar is now near an all-time high, close to 40 situations at the moment, which is quite a lot. And, you know, one of the key reasons we're seeing this, and what our beliefs is, and we've been telling all of our clients, is that companies are looking to try and create value in some form or fashion in this market. So how are they going to do this? They're not doing it through the traditional way via an IPO, because last year there was over 1,000 IPOs. It's 80% drop this year. So IPOs is not happening through that value creation anymore. Companies, especially in this market, aren't going to be willing to sell any of their segments at this point in time. And the word SPAC is such a dirty word that it's not happening anymore. So the 4th option for these companies at the moment, whether they like it or not, is to announce a spinoff, announce a value creation spinoff. So we've seen, again, like I said, there's been a lot of names in the market. Johnson & Johnson, big names, GE, Danaher is doing their 4th or 5th spin in the last 4 or 5 years. Kellogg's is doing a 3-way split, and even across the pond, Novartis, they're also on the calendar to do a breakup. So that's what and when we say spin-off, everyone, just to clarify, we are saying a distribution of shares. So put it simply, if you own shares of the parent, you're going to get shares of the spin-off, whether you like it or not. And that's where we see the opportunity in a lot of these situations, these 40 plus, as mentioned, or close to 40 names on the calendar going forward. So with that in mind, the study. So the study was produced to try and increase the odds of finding the right idea. So I mentioned all these situations coming up. What should you be focusing your time on? And how can we find those opportunities? So as Jim mentioned, this week, we released our spin-off manual to clients. It's a comprehensive examination of the last 22 years of US and European breakups. So that's including their performances, how they've broken up down the line, their sectors, market caps. So any clients listening in today, and if you had missed it in your inbox, do download that. Take a good look at that. Also, you can download it off of our website. But 40 with nearly 40 spins, as mentioned, in the next 12 to 24 months, how do investors know where to look for the best returns, especially in this environment? So this is our proprietary data, and it's going to give insight that we believe is not going to be found anywhere else in the world. And this data will help inform all future edge research and recommendations going forward. So we're very, very excited for that. So some of the key questions that we try to answer in this report, obviously, which performs better, the parent or the spinoff? What's the best sector that you should be focusing on? Some of these sectors may surprise you. What market caps perform better? Does it matter how long the management take to prepare for a spin? So meaning, if a company decides they're going to take 6 months or less to create a spinoff, does that mean equate to a better return for the spinoff post-spin or worse? So we try to answer those answers in this study. And then some of the key findings that we found, which was quite interesting, 4 out of 5 spins, or close to almost like a 50-50 split, or a coin flip, failed to generate value or make money in the first year of trading. So while spinoffs generally, there have been times you could buy a basket of spins and they may work in certain periods of the market, it is prudent to obtain targeted analysis to understand the underlying facts, so that you can evaluate the relevant investment risks before getting involved in any of these spins. And that's where I try to come in play. But what was interesting is, yes, spinoffs still outperform their parents and the overall market over time. So it's a great area to still look at, but we just have to go a little bit deeper to find out where in that spinoff space you should be looking at. So as mentioned, the spinoffs overall outperform the market. You can see some of the data there with regards to a 1-year return. So again, this is over a 22-year period. But yes, there's a 17% return for the first year of trading, 25% growing if you're going for a 2-year return, a longer period. And there are several reasons why for this outperformance. And I guess with a more pointed focus on managing such a smaller business, being one of the more notable reasons, in most cases, the managements of these spinoffs have some sort of incentive compensation plan that are directly tied to the company's performance. So this acts as a motivating factor for the outperformance. So in all of our research, that's what we're also looking for. We're looking for management that are incentivized to spend the extra hours at work to get their share price up and create a valuable product for their shareholders. So as mentioned, so from that data, we can see spinoffs on average outperform the market. Now let's just go a little bit deeper. We want to figure out, okay, so we know spinoffs outperform, but what are some of the better sectors to be invested in to increase that outperformance that you're looking for and investors are looking for? And interestingly enough, out of the sectors, you can see a bit of an array of terms of frequency in sectors. So industrials, interestingly enough, are the largest portion of spinoffs that usually take place, around 15% of all deals. This is like going by 1,100 deals that we looked at over the past 22 years. Consumer and IT follow those directly. But here's the interesting angle. If you look at all of those different sections in that pie chart, the smallest one is actually the more profitable one in there, and it's the utility sector. So we saw the fewest number of breakups out of those 11 sectors. So only 2%, I mean, very rare. And that equates to almost like 1 spin every 2 years. But when you look closer and see what the returns are for these these spins, they rank as one of the best, if not the best area to look for opportunities in the market. So if we go on that basis, so based on the 2-year post-spin returns, as mentioned, top 3, if you're looking at the parent company on a 2-year return basis, you can see utilities are there at the top, followed by industrials and materials. And if you go to the spinoff side, which we know spinoffs, we just said, outperform the parents and outperform the market. I mean, you're getting close to a 70% return on average for these utility spins if you hold them from the spin-off date up to the two-year mark, if you will. And then, of course, it follows materials and financials as well. So these spin-offs overall, with that 70% return, almost give a 3%, 3 times return versus the average spin-off return. Parents, they still give a decent return, obviously not to the same effect as spins, but they also give a over 2x return versus the average parent company. So with that in mind, I mean, why don't we just go to an example that recently happened? And we covered this spinoff earlier this year. Again, a rare utility spinoff in the market, and that was Exelon Corp, EXC. They did a spinoff of Constellation Energy Corp back in February of this year. So they completed the spinoff of their clean energy nuclear power generation segment. That's what CEG is. It's about a 30 billion market cap company, so it's quite big. And then the parent company was transitioning over to become this pure play transmissions and distributions company going forward. So right away, from the studies and from our proprietary data, we realized this is a rare opportunity we're looking at in the market, especially with US utility spins. We need to pay a little bit closer attention. And when we did the work, we saw this. We did recommend clients to get in pre-spin. It was also a good spin opportunity in terms of the technicals. It didn't have much debt. Both of them were big enough for the S&P 500. I'll go into some more technicals later on in the presentation, but it looked to be a good opportunity going forward. And what has CEG done so far on an absolute basis? I mean, for the beginning of the year, and it was much higher than this, but it's given an 80% return. And it hasn't even been trading for that a full year. So if we're going by that 70% on average return over a 2-year period, we're in good stead. And the market during that same period from February the 2nd to now was down 13%. So even the parent, I mean, the parent still has some ways to go to catch up with the spinoff, but still that is also outperforming the market. So it gives you and shows a demonstration perfectly of how a successful utility spin does go through. And what I will say, so we view our proprietary data as a unique piece for us in finding out some of the best opportunities in this space. So there's a great quote by Edwards Demon. He's a mathematician professor. He said, "Without data, we're just another person with an opinion." And of course, there's a lot of opinions out there in the market, but we're also on the other side. We understand that while data isn't a prediction of future performances, the valuable data does help us determine an edge in the situations that may be being overlooked, and potentially there could be some value there going forward. So we're kind of in the middle between the two, but we do believe this study or this manual is going to help us with our research going forward. And without trying to give away too much, we're going to look to, or right now, because we're going to lead into our next speaker, who we all call the godfather of spinoffs himself. But after we're going to come back to, we're going to lean on that spinoff data to see if we can find some opportunities in the market, and even a name to stay away from or just be wary of. So after that, we will be, like I said, I'll be highlighting an upcoming utility spin. So we looked at the example of Exelon. Is there one coming up on the market? Actually, there are two. So we will present one of those opportunities we think could be relevant to take a look at ahead of this breakup coming up. I mentioned there's a spinoff that maybe to be aware of, be wary of on the technicals, so we can talk a little bit more there, and also a taste of what's coming up. So I guess with that in mind, Jim, I'm, like I said, happy to just pause here and let Joel Greenblatt grace us with his presence. But like I said, we will be revisiting after the break some of those opportunities going forward. So hope that was useful to everyone. Yeah, let's we'll connect after Joel speaks to look at some of those opportunities in the market.
Thanks, John. So John's our deals analyst. And like I say, just weigh on Joel for 5 minutes. But essentially, if you didn't know what we looked at, as I said before, we look into the market, and people say to me, Jim, I don't understand spin-offs. We don't do spin-offs. And I say to them, well, you know, how do stocks go up? You know, we've talked a lot about today about buying cheap, and maybe it stays cheap or it gets cheaper. And that's a real problem for investors, because they see a good business and they see it going the wrong way, and then the macro implications come out, and all of a sudden, you know, you're sitting on losses already, and you're thinking I should average. And we've seen, you know, again, that's not the right thing to do. So what we try and concentrate on is that catalyst to move price to value. Now that can take a number of forms. It could be in George's, where he spoke earlier about looking at insiders, maybe a capitulation at the bottom of the market with insiders buying as a contrarian opinion. Gary, and talk about decision making, me about behavioral instances, and all this stuff that you can see is coming together, because this is the stuff that, you know, you're not taught. When we get a lot of interns, or we see a lot of analysts, you know, they're pure numbers people. But my argument to that is everybody knows about numbers. You know, everybody knows a stock's cheap. So what can you tell me else? What is your edge? And our edge really here is looking at spin-offs and trying to find out that piece in between. So John's presented the data. There's a good start for you. Is the data everything? Well, of course it's not, but it's a great start. We know where to look. The fact that utilities come out as some of the better spins, you know, kind of makes sense, because you've almost got just such a boring industry which no one looks at, and we know about boring industries can be some of the best investments you'll ever make. So it's a good start, and once we overlay it with you know, our fundamentals, and we overlay it with the insiders and stock incentives and things like that, you've got a great recipe for a stock selection. So that's what we do here. I just wanted to say that before you know, before Joel comes on here, because Joel, if you don't know about Joel, give you a little bit of background about Joel Greenblatt. If you in the investment world, you probably should know of him already, but essentially he wrote a very strange title book a while ago, maybe 20-30 years ago now. There's this one, Who Wants to Be a Stock Market Genius? Well, we all do, of course. And you pick up that book and you go, well, yeah, it's a bit of a stupid book, but I got to pick it up. And actually what it is about, it's about spin-offs, a lot of it about spin-offs and where to find hidden value. So, you know, we've got Joe on in a second, he'll be joining us, but what about Joe? Joe was one of the first investors with also Michael Berry. And if you've ever seen that movie, and I don't particularly like those movies, but The Big Short, and I haven't seen it, but I know there's a scene in it where Joel invests, one of the first investors with Berry. And you know, he's a very astute guy, and he grew through the 90s running Gotham Capital, and Gotham Capital made, you know, 50% returns plus just looking at spin-offs. So he positioned himself as one of the forefront people in looking at the space. And in his book, you know, he breaks it down into fundamentals, which are the numbers of the stocks and the breakup values, the technicals, the way the stock will move in and out of an index. You know, sometimes GE coming up, for example, we're split into three points here, three companies in January. You know, are they all going to stay in the same index? We don't know. They could drop out. There could be natural selling. And the last thing he looks at is insiders and their incentives. So altogether, it's kind of, we've taken that from the baseline and developed it a lot. And that's how we kind of analyze here at the Edge as well. So that gives you a little bit of insight into what we do, if it wasn't too obvious by now. But that's what Joel will be looking at in a second. And so I'm just waiting on Joel to come through in a minute. He's due on here at 11:40. We finished a little bit early. Got a couple of questions for you, John, here just come in actually. But we'll cross those in a minute. But there's Joel. Joel, how are you?
Good. Everything's good. Can you hear me okay?
We can hear you, see you. It's lovely to have your presence. We appreciate your time. We know you're super busy. I was just going on about your little bit of your history, your super book, which everyone who joins gets a copy in here. And I know you read a number of books, a little book that beats the market, and they're all fantastic reads. And I was just saying to the audience, what I was saying to you the other day. That you're a big proponent of spin-offs, but also the fact that I believe that a lot of investment books, a lot of business books don't stand the test of time. You know, if I go to, let's say I go to a Jack Welch book, right, back in the 80s, that was the way it was done. He had a system. Would that work today? No, I think that system is obsolete. Your book essentially has come full circle. From what we see, our firm looks at spin-offs and things like that. We've seen spin-offs are undercovered again. Analysts ain't covering them. I said to you the other day, the one main GE analyst on the street said to me, he's not covering GE anymore because it's breaking up. GE is one of the staple US stocks or US owned stocks forever of a small investor. They get these spin-off entities on their accounts in the morning, they're instantly sold. So all this stuff that you said 20, 30 years ago is just still there. And you can't argue or anyone can argue that the market becomes more sophisticated in that area. In fact, it's stayed the same, if not, it's got worse. So for me and my firm, that provides a great opportunity. But I wanted to bring you on today to give your kind of ideas for people, people expecting great things for you to say and your insights. And we're super pleased to have you here and supporting the cause. We love that. We reached our target of 15,000, just so you know. We're super pleased to have you. So, like I say, the field is yours, Joel. You tell us what you think you're seeing in that space, and maybe anything else. And I'll leave it over to you. If you've got questions for Joel, put them in the Q&A and do like a 5-10 minutes at the end, and we can grill him, and we can get a little bit more out of him.
Okay, sounds good. Well, I love questions. I taught for over 20 years at Columbia, and so that's more fun for me. That's how I learned than talking. So I look forward to your questions. I'm glad Jim mentioned that the book is still relevant 30 years later, because I'm going to talk a little about that. It wasn't just about spin-offs. Maybe a little less than half the book was about spin-offs, but anytime there's something extraordinary, whether it's a merger or bankruptcy or a recapitalization or anything weird going on with a business, it's ripe for opportunity. The way I described it in You Can Be a Stock Market Genius, I should have used the subtitle, which is The Secret Hiding Places of Stock Market Profits. That's probably a better title for the book. Anything's a better title. But anyway, I opened the book with a story about my in-laws who used to have a place in Connecticut, and they'd spend their time at country auctions, antique stores, estate sales. And if they found a painting in one of those places, this is very important. They didn't ask, is this painter going to be the next Picasso? that takes a certain talent set and an ability to project into the future, and a lot of other artful talents that perhaps they didn't have. Their question was not, is this going to be the next Picasso? Their question was there just a painting by the same artist in a similar genre that sold at auction for twice what I can buy this for, or 3 times? And then they would go buy it. And that's a much different skill set. That's a skill set of being willing to sort of sift through a lot of junk and go to off the beaten path places and find something that's a mispriced because it's more harder to find. And that's really the way I look at special situation investing. I don't know if you guys read, it was David Einhorn saying, hey, there aren't really many analysts on the calls anymore. Everyone's indexing and no one's really doing a lot of work. And, move that down to the spinoff or recapitalization world or whatever, and then move it down to things that are a little bit smaller or more complicated or whatever. There's still opportunity there. And so just have a few tips if you're going to be in this space. So I think the opportunities, as Jim mentioned, are going to be as big going forward as they've always been. I got 5 kids. The ones that were interested, I taught this skill set to. I'm not so much in the space. I'm doing other things. There's a lot of ways to make money in the stock market. If I were starting again, this is, you can be stock market geniuses where I'd go. Because what happens to people who are good at special situation investing is they do pretty well, and they get sized out of some of the smaller situations. So it kind of leaves a new generation to be able to take advantage of those and maybe create wealth that, let's say, have an unfair advantage to get returns. So I'm just going to go through a few tips, and maybe I'll take some questions. One is, when you find something really good, concentrate. Okay. Everyone learns about diversifying their portfolio and how prudent that is. And I'm not saying it isn't, but, when people look at modern portfolio management and they can get price quotes on a daily basis, they start looking at statistics that don't end up meaning anything. I think Warren Buffett had a story of, he walks into a town and he sold a business and he got $1 million, and now he's got to put the $1 million to work in something else. And if he investigated 200 businesses in the town and then narrowed it down to 30, and then visited with management and looked at the ones that had a good future, that were run by good stewards, and he really spent a lot of time. And then he divided his $1 million into 6 or 8 of those businesses in his town that he decided were the best. Prospects, good management, nice futures. No one would call him sort of crazy. They would call him prudent, that he divided the $1 million into 6 or 8 different businesses that are carefully researched. Yet, modern portfolio theory and, statistics, and you get daily quotes, people will think that's, way under diversified. But when you think about it as ownership of businesses, of course, that sounds pretty prudent. And that's really the way to look at special situation investing. If you spent your time looking at things, and you should be limiting your risk that way in each individual investment. And then if you divide it in 6 or 8 things and you've really done your work, you're being pretty risk averse. So one of the best investments we ever had was we found a company that had a very complicated capitalization structure. But if you really sifted through it, and it wasn't easy, you found out that you were buying a business at half its cash value with a really good business attached. And so if you bought 1 or 2% in your portfolio of that, and then it doubled or something, you didn't do a good job. You did a terrible job, because you're not going to find many of those. So you should have, 15, 20, 30% of your portfolio in something like that when you're buying something half cash with a good business attached. And so you should realize that if you put 1 or 2 or 3% or even 5% of your portfolio into something like that, you blew it. And so if you find something good, and you usually can find them in the special situation space where there's these unfair bets that you can take, then really take a bet, concentrate. And that's, very much along the lines of what Warren Buffett would recommend as well, and how he started out and made a lot of money. Spinoffs are still great. Jim mentioned GE. I may even look at this one. I'm not really that concentrated in the space, but this is a classic where, there's an aviation business, there's a healthcare business, there's a power business. They've been hidden. They've actually been run by a pretty good guy from Donahere over the last few years. So I doubt there'll be too many surprises left, but it's complicated and it's a mess. And I think there's the healthcare spinoffs happening in January, and then the following January will be, the rest of the business will split into two. And so there's a lot going on over the next year. And so there's a lot of catalysts, and, you can do some of the parts, and I think where I would go first is the most hated business, probably power, and look at that, just because no one in their right mind would buy power. And it reminds me of what I wrote in the book, but really didn't give all the details. Marriott split into two businesses. Many of you know the story where Marriott, which is the management company, is an asset-light business that has a network that people can, go to the Chicago Marriott or whatever it is and sign up in the network, and they get paid a management fee for being in the network and managing the hotel. It's very asset-light. But they also had another business, Host Marriott, in the early 90s, that actually built hotels and then kept, sold the hotels and kept the management contract. But of course, they got caught in a real estate downturn in the early 90s, and they decided to split off. And that business had a lot of debt because they were building hotels. They split it off into two businesses. And the way it was described in the papers, no one would want to own the real estate company, the one that owned the real estate. And we looked at it. And the reason we made the money, I didn't even explain this in the book, is that most of the debt was in a subsidiary, which means the parent company had unencumbered assets. And if you looked at the unencumbered assets, they were worth about $6, and you were paying $4 for the stock. Plus you had all the upside on the company that was very leveraged, the subsidiary that was very leveraged, that held all the debt, and that the parent wasn't guaranteeing. And so it looked like a big mess if you consolidated everything. But if you looked on page, 137 of the prospectus, it was very clear that the parent wasn't encumbered by this debt. And so we actually were paying $4 for $6 of unencumbered assets, and plus a lot of upside on the levered assets. And so if you saw that, you would say, I might want to buy a lot of this. And we did. And that's how we made our money there. I think it was a little too complicated for the book to give it quite those details. And it was a little more complicated than I said, but not really. That was the big picture. And the nice thing about special situations, you don't have to be a great analyst. You don't have to be predicting the next Picasso. You're just sort of doing more work than everybody else, and maybe looking at page 137 that actually had a chart that showed that it wasn't spelled out. And one of the great things about that was it leads to the next point, which is, and Jim mentioned already, what are the insiders doing? Take a look at where are the insiders going, where are their incentives, where they're keeping their stock incentives, where, what are they managing when there's a spinoff? See, how their bread is buttered. One of the best definitions of economics, I forgot the name of the economics book written for, simple purposes, was people respond to incentives. And in investing and management, look what the insiders are doing. Everyone responds to incentives. The other great thing about spinoffs is when you have a complicated three businesses like GE does, if you separate them, you can go to the highest and best buyer. And usually people are trying to conglomerate and buy more assets. When you're splitting up, the only reason to do that is really to try to create value. And so if you can buy the aviation business alone, or you can buy the healthcare business alone, or you can buy the power business alone, the highest and best buyer can buy those. And so not until they split up do you see that. And so it's worth doing the work, and it's not easy. And I think the Form 10 is out already for healthcare, and you guys can take a look at it and, for GE, and that would be a good example of that. The other thing I mentioned in the book is do your own work. You're not going to get some very nice research report telling you how to make money that's hidden or whatever. We made a lot of money years ago in one of the first Liberty Media spinoff, where it went up 10x. And if you just looked at the incentives and what John Malone was actually doing without even understanding the assets that well, you could see this was all being laid out to make a great special situation. So once again, it was really looking on page 237 to see what was actually going on and looking what John Malone's incentives were, setting things up. And that's continued for years and years. That's the gift that keeps giving in the spinoff world. And then otherwise, the other tip I would just say is look for difficult or weird things that just are not normal looking. And so these are weird securities come off of mergers and acquisitions. They're produced for various reasons. And if anything is a little bit strange or a little bit or a lot complicated, there aren't that many people looking at them nowadays, especially on smaller situations where, so if this is still a great area to make your fortune in, and take and find by getting paid for doing work as opposed to taking risk. So I think that's another way to think about it. And the last little tip, and this is more along the lines of what I'm doing now is, and I just thought I'd share, is that I haven't seen a dichotomy in stock prices like this since the internet bubble. At Gotham Capital in 1998, market was up 28%. We lost 5%. That was our first year of losing money. I started in 1985. In 1999, we lost 5%. We had a concentrated portfolio. Market was up 21%. So market was up 28%. I think in 98, we lost 5. Market was up another 21% in 99. We lost 5. In 2000, market was down about 10% and we were up 114%. We weren't idiots in 98 and 99 and all of a sudden geniuses in 2000. We just got paid for being patient. And so the last thing I'll tell you is we have a lot of analytics now. And so we can look at the S&P 500 and look at where it's priced, at least on a cash flow basis, and so a little bit more sophisticated metrics relative to where it's been priced over the last 30 years. And right now it's in roughly the 30th percentile towards expensive. So even after the market's fallen, still more expensive than average over the 30 years, but that still indicates a return of about 16% over the next 2 years. So that's the S&P 500. That's not a prediction. That's just saying from these cash flow yields in the past, from about these interest rate levels, on average, market's been up 16% over the last 2 years. But if we have something called the Value 1000, which just buys the cheapest companies, don't ask me why it's called the Value 1000, out of the 1,400 largest, just buys the cheapest ones we can find, has a portfolio that has the equivalent diversity of 300 or 400 names. So really just buying the bottom 20%, bottom 25%, and updating on a daily basis based on cheapness. Right now, that portfolio is in the 93rd percentile towards cheap over the last 30 years. And when it's been here in the past, 2-year forward returns have averaged over 63%. So that's quite a dichotomy between cheap stocks, the way we define it, and that's a cash flow oriented metric like a private equity firm would buy things, and the S&P 500, which probably has better names. 30 years ago, returns on tangible capital were about 20%. Now they're closer to 65 or 70. So market should be more expensive. These are better asset-light businesses that invest their money better, don't need as much money reinvested, so their earnings are worth more. So I think the numbers I'm giving you are a little light for the S&P 500, but nevertheless, 30th percentile versus 93rd percentile for the cheapest names. And that's a big dichotomy, and I haven't seen anything like this since roughly 2000. So that's my 2 cents, and happy to take questions. Just a little update on the way I'm thinking.
Fantastic, Joel. That was great insights. And I guess, I have a question which, I ask myself on a frequent basis is one about, we've just completed our 22-year study of spinoffs, right? We've looked at every single piece of data of a certain market size. We've gone through them. And what you said was interesting. You said no one likes a power business. you know what, on a 1 to 2 year basis, the best spin-offs, and John just announced it beforehand before he come on, were utility spin-offs, the most boring companies in the world. And I thought that was quite interesting. But overall, there is great performance, as you well know. You don't need convincing of spin-offs if you were to hold them. So, but here's the thing: if the data is pointing to the fact that spin-offs are value creating and compelling on a performance basis, why are investors not looking at these things more?
Well, that's a good question. And first, I want to give a caveat. I would say that my point in the book where spinoffs are primed for mispricing, meaning they're new securities that haven't traded on their own before, and they can be overpriced or underpriced. On average, because they're complicated, on average, because most people bought the main stock for the parent company and not usually for the spinoff company, they're usually not the right holders to begin with. So you have that opportunity to buy them reasonably cheaply. And so there's just a natural supply. And they're not sold. There's no incentives for brokerage firms to sell them, or no IPO show usually beforehand. And so they're set up to be underpriced. But it doesn't really matter if they're underpriced or overpriced. They're set up to be mispriced, okay, and to find their way. And so all I was really saying is this is a pregnant area to look at, okay? If you're looking for mispricing, could be overpriced or underpriced. The fact that on average they're underpriced, that's great. But you still have to do your work, right? Average is just average, right? You don't want to die from just buying them all. And, if you know how to do value analysis, then, this is de novo. I mean, this is prime place to do the work that the market hasn't done yet. So I still think they're great. Why don't more people do it? A lot of them are small. Most of them are complicated. Most people don't do work. And if they're particularly small, what I tell my students is, look, what happens to people good at special situation investing? They make money and then they can't play the small ones anymore. And so it's always right for a new generation to come in and try to take advantage of these things. And people accuse me of trying to make it sound easy, and I don't think it's easy. I think it's hard, and you're on your own. You're doing your own work, and you can't really, when I mentioned Liberty Media, there's a big article in Forbes before I looked at Liberty Media saying, don't touch this thing. But when I looked at it, they had mischaracterized certain things. So, media, these aren't trained analysts. They buy a story, FTX is cheap and that guy's a genius or whatever. And that's what the media wrote. But, maybe do your own work is another time to listen. And so most people don't do their own work. So if you're willing to do work, it's nice to know that you might get paid. And spinoffs have certainly, and special situations are certainly still a great area for that.
Well, yeah, I agree with that. But also, I think, let's characterize that or crystallize it, if you like. And, people want profits fast and they don't want to do the work, right? Same old adage. But I think, there's a new concept that's come in recently. I think spin-offs during the later years, maybe 14 to 17 to 18, that sort of period where people jumped on the bandwagon of spin-offs, and the Malone stuff popped up and the Dilla stuff popped up, and everyone went, hey, this is just free money. And I think that, those sort of stocks really turned around, particularly IAC recently, where, just absolutely value destruction in the stock because people assumed that, to just hold these things, not do the work and get a lot of value from it. So I think, there's a kind of, and I was talking about this earlier, and we had Gary Klein on, who's a cognitive psychologist as well. There's a behavioral bias as well, and you got to factor that into a lot of your names as well as the analytical stuff that you do. So I think that's changed for me a little bit as well. But like I say, I think that I just don't think people look at them, even the big houses. I mean, houses, as you know, Wall Street Research has got very fragmented. What's the value in research now? Buy, sell, hold. Do I care? Not really. Do I care if it's got some sort of change in it? Yeah, that's interesting to me. So I guess another one of the questions come in was, if you were to, you mentioned, you start at special situations. That's great in a portfolio. I mean, how much are you would allocate to kind of spin-offs in that portfolio or special? I mean, surely you wouldn't do a whole portfolio of special situations. Are going to be a percentage, or what do you think? Because they can be quite volatile.
The way I ran my portfolio when I was running a concentrated portfolio, now we run sort of systematic portfolios, long, short. And it's not because that's a better thing to do. It's just, I really enjoy this business, and it's another way to make money. And it's interesting to me to sort of take the principles that I've used my whole career and systematize them in a certain way. So they're both interesting, but they're both full-time jobs. But the way I ran the portfolio was, there were spots for 6 or 8 names. If something wasn't going to be a 5 or 10% position, I didn't bother. I didn't bother owning it. And usually it was a ranking system where, okay, I did research on a situation. I could rank it amongst the things I owned. And was it better than something I liked? Usually the problem for value investors is that you like it when you bought it, but of course, if you're right and it's on its way, if you bought it at $6 and you thought it was worth $10 and it's on its way, and now it's at $8, not as cheap as it was, still cheaper than you think it should be. And if you're a value investor like me anyway, you're really cheap. So $10 was a very conservative guess. So now you're struggling because now you found something at $5 or $6 that you think is worth $10, and where does it rate in your portfolio? And so that's not a question I can answer in the wild. That is, I would prefer to have all special situation investments, as long as they're not the same special situation. I started out in the risk arbitrage business, and so I once had 8 deals break all at the same time. I thought I was diversified, but of course, if nobody can get financing, they're kind of correlated with each other. So you have to really be diversified in that way. I mean, if there's a lot of deals being done in, utilities, you don't want 6 or 8 utilities. But with that caveat, meaning you're a normal person who wants diversification in their portfolio, if you could find 6 or 8 special situations to fill up your portfolio with, that's probably my favorite portfolio. Right. There are taxes and other things. You could have a core portfolio of things that you think are compounders, and then, have 40 to 60% of your portfolio then. And then with the other 40%, you're sort of playing with special situations. That's a way to go. Actually, one of my kids really, who I taught and really loves this stuff, really runs his portfolio that way. I've backed investors into business. I don't do that anymore, but I used to do that, 20 years ago. And I backed one of the best analysts I ever found, but 6 to 8 names were too concentrated because he was so smart, always knew what could go wrong. I wasn't that smart, so I was willing to take bigger positions. And when he changed his portfolio to 15 or 20 names, then the hurdle didn't have to be quite as high because the risks weren't quite as high. And that was better for him. Okay. And then he really started to take off. So, everyone is different. Everyone has a style, portfolio management style, has an investment style that's better for them. And I think the most important thing, all investing is figuring out what something's worth and trying to buy it at a reasonable price. Okay. And the more confidence you have in your work, you don't have to ask other questions. I mean, hey, it's worth $10. I really feel like that's a conservative valuation and I own it at 7. I'm not going to lose sleep if it goes to 6. I might buy more. I mean, those are my favorite positions when I buy something and then it goes down. And by the way, unless you bottom tick something when you're buying it, you're always down after you buy it, right? Unless you got the all-time lowest tick after you buy it, you're always down. So you have to have confidence to stay in there. And that comes from understanding what you own. And that's really the key to investing, understanding what you own. And it's not that I understand that much stuff, but I understand what I don't understand. Warren Buffett calls it a circle of competence. Okay. So you can take bets, you can, I don't have anything against people who buy crypto. But just realize, as Ben Graham would call it, it's speculation, because crypto doesn't earn money. Gold doesn't earn money. There's no way for me to value it. It's whatever someone will pay me down the road. And I'm not saying anything else other than that. It is a speculation. I would also call anything, Chinese stocks a speculation. There's no rule of law or protection of property rights. And so not clear if the numbers mean anything either. So you could take an intelligent gamble on those things, but I would call that speculation, not investing. And it's for different reasons. It's not because they don't maybe earn money. It's because I don't know if I'll ever see that money. And there's no rule of law. I mean, one of the best books I ever read for investing was a book called Red Notice by Bill Browder.
Fantastic.
And
Well, that almost scared me.
Yeah, but he was investing in Russia, but I extrapolated not too far to investing in China and saying, no, when there are no rules of law, you can't intelligently invest. You can speculate all you want, but that's what you're doing. And so that kept me from losing money on things that looked like quote unquote bargains in China and good prospects and growth and all those things. I just avoided it for a simple reason, very globally saying, I don't trust that that the rule of law exists here, or that my property rights will be respected. So you can't invest under those circumstances. You can speculate maybe.
All right, so thank you. That is sage advice there, really. Know what you own. But that's great, sir. That's fantastic today. Got great insights from you. I really appreciate you coming on, spending your time with us. Do you got any more books coming out, or is
I do have one coming out. I can't really talk about it, but I'm very excited about it.
Come on, you can't really talk about it. What's that? You can't talk about it.
I'm very excited about it, is what I'll say, and it's new and different. So it's an investment book,
you know my address, Joe. I'll review it for you. How about that?
Yeah, I can't really talk about it, but I'm very excited about it.
Fantastic, man. When is that due out? Can you tell us that?
No, I'm hoping it comes out in the next year. I think there's some business reasons that will drive it rather than rather than the book, but I'm excited. So thanks for having me on.
Fantastic. All right, Joe, have a great day.
Money for a good cause. Okay.
Fantastic, man. Thank you for your time.
Bye-bye.
Bye-bye. Okay, great. I hope you got a lot out of that. I certainly did with Joel. It's been around a long time. Big advocate of special situations, particularly spin-offs, and the fact that no one really looks at them. But as you've seen, they're very value creating, and it's kind of looking in that pile to see what the best ones are. So we're going to take 5 minutes break. We're going to come back at 12:15. John's going to come in with a few ideas from our study. I know there's a few questions coming on the study as well, but he'll answer those. And it'll also give you a couple of picks of stocks which you should be looking at down the line. You heard a couple of spins mentioned there by Joel, one by me, the same one. GE splits up into 3 in January. There's a couple of other big names coming up, Kellogg and also Johnson & Johnson. So huge companies really are spinning off. And I just think that, you're going to see more and more of this as markets kind of stagnate and companies, big companies now, it's coming the other way. They're going to have to split up. They're going to have to split up to create value, to create more nimble companies that are accessible to investors. So your Facebooks, your Amazons, your things like that. So, and they got great breakup value. So definitely a place to hunt for you. If you're not hunting, check in with us and give us a call. But give 5 minutes, come back in 4 minutes now, and John will be on and they give you some ideas in what to look at based on our study findings. Thank you.
All right, everyone. If you stay tuned for the next 15-20 minutes, we'll wrap this up. But yeah, great presentation from Joel. I hope everyone took some notes. I know I certainly did. So on that note, let's go back to where we last left off with regards to looking for some opportunities as a result of the study. So let me just share my screen here for you guys. All right, so here we are. Let's go back and here we go. All right, great. So where we last left off, I did promise we would look at a couple situations. As mentioned, I can't even go back to the beginning half of it, but we looked at sectors that performed better than others. So if we remember what we saw previously, so one of the sectors was utilities, and one of the some of the numbers, if you will, saw that on the parent side for utilities, 24% return, utilities 70% return on the spin-off side, mixed in with the industrials and also materials sectors have done pretty well. So just keep that in mind with regards to the upcoming situation. So we just move forward now. Great. So with that in mind, let's get into that stock. So I mentioned there are two situations right now on the calendar, a pending third, but I wanted to raise this particular situation just because on the face of it, it doesn't actually say utilities. It's an industrial company. But once you pry into the situation a little bit further, you realize, yes, there is a utility aspect to it. And you are actually just going to be waiting on that Form 10 to come out, as Joel said, once we get all the numbers and incentives. But it's definitely worth looking at today, doing some work. And that company, guys, today is going to be MDU Resources. Anyone's heard of that? MDU is the ticker. This is a 6 billion market cap company. And they recently announced that they are going to do a separation of their construction materials business. They also have a contract and services business. That's going to be separated from their core regulated utility and infrastructure business. So again, two businesses that don't really go together. And you could say that MDU currently operates as a conglomerate structure. So they have utilities, pipeline, construction materials, contracting, and construction services. So this is actually going to be taking place first half of next year. It may even squeeze into Q1 of next year. So I would say somewhere around March or April, they will likely do the breakup. As mentioned, the parent company, the RemainCo, is going to be the utilities portion of the split. That's going to be the regulated utility and infrastructure business. And then Knife River will be the construction materials business going forward. Interestingly enough, there's an activist investor in this, Keith Meister of Corvex Management. Now, I mentioned in the previous example that CEG was the spinoff. That's actually the top performing spin for this year alone, 2022. He got involved in that just after the spinoff from Exelon. So it seems like he's done very well with his investment there, and he's looking for more. So, you know, someone is feeding him our data with regards to utility spins, but he's come on board to do this breakup. And like I said, he has obviously seen something in this business going forward. So we like that from that perspective. One of our previous speakers mentioned it's good to, you know, get paid while you wait for these situations to go through. So this does have a roughly around a 3% dividend yield right now. We are expecting the Form 10 to come out shortly, so we don't have the ratios or distributions just yet. But it hasn't really moved so much since the announcement date. They announced it back in August 4th, 2022. So it's only moved up about 4% since the announcement date. So it hasn't run away from us as some spins tend to do. But like I said, we at the Edge are definitely going to be doing the work on this one, as we expect the Form 10 should be out in the next month or so. That's what management are guiding for. So that's one name that really stands out in terms of the space itself. And like I said, on the face of it, it's not your typical utility breakup, but it does have an industrial aspect to it. And I also did mention that industrials are one of the one of the top sectors as well. So it may be even a play to look at both parent and spinoff in this case. Now, we are also going to look at a spinoff to be wary of. As Joel Greenblatt mentioned, this is a good place for mispricing. So whether it be undervalued or overvalued, that's where we're going to look for these situations. And right away, from our standpoint on the technicals, we can look at the situation and see whether there is going to be some selling pressure on the back of a listing of a company or not. And this one, potentially, if it's in your portfolio, the SpinCo could see a bit pressure on day one of the spin, and that is going to be Fortune Brands Home and Security, FBHS. This one is coming up with their tax-free spin Q4. They were guided for a Q1 spin, but the management decided they wanted to raise up the timeline on that one. So it's going to be coming up in the next month and a half from now. Could you believe it? We're already coming up to December. So that's coming up very shortly. There is a Form 10 out. What they're going to be spinning off is, oh, exciting, their cabinets business. So that's going to be called Master Brand Inc. They've already released a ticker for that. That's going to be MBC, and that's going to be separated into a listed entity. What's going to be left for the parent company? They're going to be renamed themselves to Fortune Brand Innovations. So FBIN is going to be the ticker symbol, but it's going to be their water innovations business and their outdoor and security business. That's what's going to be left with the RemainCo. And Fortune Brands is one of the #1 sellers of cabinets, locks, and faucets in North America. So this is coming up, as mentioned, but and they recently updated their prospectus a couple of days ago. So you can go into the SEC website and pull that down today. Now, this was actually a previous spinoff over 10 years ago. We would have covered it. I remember covering this spin where they were spun off from Beam Inc. And Beam Inc. was previously Fortune Brands, and Beam was a pure play spirits business. So FBHS became a leader in the home products industry. The stock has done quite well since the spin. In fact, Beam was taken out 2 years after the spinoff itself. So they do have some DNA with creating value. But excuse me, but just looking at the technicals, what could this mean for this new cabinet business going forward? We always look for that. So without even doing the valuation, and we'll have our valuation out to clients in the next week or so, what could potentially move this spinoff from an overvalued situation to a potentially undervalued name? And on the technical side, the first thing that jumps out to us is right now, Fortune Brands is an S&P 500 name. The minimum criteria for the inclusion for the S&P 5 is 8.2 billion. Right now, Fortune Brands is a 8.4 billion market cap company. So once you split this company in two, the faucets business or the SpinCo is going to be too small for the S&P 5. So as a result, it's going to get kicked out of the 5. It moves into the mid-cap 400. And as a result, there's going to be some forced selling. So those S&P 500 only funds are likely to sell their stake in the faucets business. Another area of potential technical play, which we like to calculate, is the fact that MBC right now has not decided to pay any dividends, at least in the near future. So right now with Fortune Brands, they do pay a dividend. I think it's just shy of a 2% dividend yield right now for the parent company. If the spinoff is not going to pay a dividend, or at least, like I said, right away, you will see a lot of dividend-only funds looking to get out of this name. In fact, we have a couple clients on our distribution that only will look at the spinoff if it's paying a dividend. So they're not even going to entertain this company until they decide they're going to look into this spin. So These are some things to be aware of. Like I said, without even going into the technicals of the RemainCo being the higher margin business and the cabinets business being the lower margin, where the cash and the debt is going. But it's just pointing us in the direction of either where to stay away from, what to be aware of is in your portfolio that might be coming up, and some of those long short guys as well. This might be an opportunity to play a situation around the spinoff as well. So those are the two names we wanted to highlight today. Kind of a one to definitely look forward to, one to maybe even just wait for it to sell off, and maybe there is that great opportunity to take place. And all the completed spins for the last 22, 23 years have shown that with the last two annual percentage dips that we've seen with the S&P 500. So that's in 2015, market was down 1%. 2018, this market was down 6%. The data shows that if you buy a basket of all global spinoffs the following year, so meaning 2016 and 2019 respectively, if you held that basket of spinoffs for a 1-year return, you actually would have doubled your return versus the market that same year. So I think the rebound from 2015 to 2016, the market was up roughly around 10%. Spinoffs, if you held that 2016 list the following year, you were up 21% return. If you look at that from the same 2018 perspective, again, you were up 45%, where the market did very well. It was a 29% bounce in 2019. But the spinoffs, because they had fallen off the way they have, they had a really nice return. Again, this is just owning a basket of all spins and looking blindly. So with 2000 following the way it has been with this market dip and this trend, and also we mentioned earlier in our conference that the spinoff opportunities are greater than ever, close to 40 breakups, and that's a near all-time high. We believe that 2023 leading into 2024 could be a very strong year for spinoffs. So it's a great space to be looking at, as Joel also mentioned, as co-signing that as well. So here's a taste of what's coming up on the calendar. I mean, we have a lot of names coming up. I mean, we have Fidelity National, FNF. They're doing a partial listing of their annuities and life business. That's coming up. You have one of the world's largest asset management firms, Brookfield Asset Management. They're going to be looking to separate their asset management business going forward. Keeping in the asset management firm, Jefferies, they also have a spin-off coming up where they're going to be spinning off their oil and exploration and drilling business, so kind of a ONG play there. iStar is doing a weird complex real estate spin merger with a company called Safehold. SAFE is the ticker there. Home builder Lennar Corp. Whether it does do the spinoff in Q4 or maybe Q1, but they're guiding for a spinoff of their non-core assets. I mentioned Fortune Brands, what's coming up there in the next month and a half, so stay tuned for that. GE has been mentioned a few times today. They're doing part one of their three-way split by spinning off their healthcare business in the first week of January. So the Form 10 is out. We have our analysis out very shortly. And then, of course, we have Bosch. They did a spinoff of their, or IPO'd, I should say, their eye care division to their shareholders. They still own 90% stake in that business, and they're past that point where they could distribute the shares to their shareholders. And all of that is just for Q4 of this year. So we have a lot of work to go through. That doesn't include all the other spins coming up on the calendar for 2023 and onwards. So definitely, as more eyes and views regarding spinoffs come to the market, we believe this can create more inefficiencies and create more opportunities. And all of this data that has been mentioned and that's been going on is just to help add intelligence to our already value creating space for our partners. So I know that's my time for today. If you've got any questions, I'll try and answer some of those right now with regards to the ideas or the data, but also feel free to reach out over email. We can set up a call, but I'm even happy to come by your office and explain in further detail what we found. But appreciate all the time today. Like I said, I'll hand this over to Jim shortly, but hope you guys took away a lot today. And yeah, thank you so much for joining. All right, should we take a look at any questions? You want to jump in?
Should be down there. Any questions, John?
Mm-hmm.
Yeah, scroll down after Taylor.
Mm-hmm. All right. So liquidity was a question that came about. So stock liquidity, how do we think about stock liquidity? I mean, that's a good question. I would say most of our clients need at least some go as low as 1 to 2 million average daily volume ADV. Some will need a minimum 10 to 15 million per day. So, what we try and analyze, I mean, the names we've highlighted and a lot of the analysis done, we were only looking at companies or parent companies that were at least $500 million on the day of the breakup, and then they split into two. We still have a list of companies that are 200 million, 300 million, which is going to be too small and illiquid for our clients at the moment. So we on the calendar limited to about $1 billion. The study mentioned it goes down to 500. And then we have a whole host of other situations that we can analyze to see how those small and micro cap situations look as well. So in terms of stock liquidity, yes, it needs to be liquid enough for our clients to take a look at. Like I said, the minimum we'll go is a couple or a few million AV, maybe even higher than that in this market. But that's how we look at the liquidity side of things. Let's see what else is there. Enjoyed here next year. How to overcome challenge being trust. You could take that question. Let's see, maybe segment financial spinoff disclose the 10K one before. Yep. So good. So I'll take this question. Maybe Jim could take the other one. But given segment financials of a SpinCo are usually already disclosed in a 10K or a Form 10 in that case, what additional information and value do you get out of the Form 10? So out of the Form 10, we get the distribution ratios. We get how much cash and debt is going to be given or by the parent company to the SpinCo, and how much debt there is. And as Joel mentioned, if you dig deeper into some of the filings, so page 298 rather than page 1 or 2, you may even find out the incentives and the management incentives. Usually that comes about 1 quarter or even a couple of quarters after the listing. But also on the Form 10, they will guide on any weird distribution of situations to the SpinCo that could potentially hamper it. So for example, with Honeywell, when they did a spinoff back with Garrett Motion, we saw that if you looked deeper into the Form 10, they highlighted that there was going to be a lot of liabilities that were going to be asbestos liabilities, to be more specific, for Garrett. And of course, that was too much for Garrett to handle. They went bankrupt and came back on the market recently. So that was something that was disclosed in the Form 10 that may not have been in the 10K. So it's the Form 10s that give a lot more detail to the SpinCo itself. The 10K itself is just going to be more numbers oriented and how it's done for the year. That's the annual filing for the company. So you get a lot more details out of the Form 10. And be aware, previous Form 10 and the amended Form 10 could be completely different. It could change the free float of the business going forward. So always take a look at that from that perspective. Make sure you have the latest Form 10 going into the spin. And sometimes they update that 2 or 3 days before. And I think like that's it on my end. You can maybe do a little bit more of the overall viewpoint. Was there one more, or shall we leave it at that?
Where's the overall, John?
Just suggestions for next year, how to overcome the challenge of trust from the investor in our current business climate.
Thanks, John. Just that last question. I mean, the market comes in ebbs and flows. I mean, if you look at, and it works, it's cyclical, and arguably, we're always on a 10-year cycle. Happened in 2001, happened in 2012, 12, 13, 14, and then again, so, and recently last year, when optimism gets so great, you got to recognize that, and how much is in valuation and how much is in just euphoria. Again, look at my Forbes blog. There's a great book in there, Panics, Manias and Crashes. And it just talks forever in history about those same cycles. And my argument is the cycles are the same. They just come in different disguises. So they came in different disguises in the internet boom, in the growth from last year, Bitcoin, whatever you want. So you just got to kind of recognize that. And I think today, what we try and do, or what I try and do as an investor, is look to find an edge, and I always ask people, what is your edge beyond the market, or what the market doesn't know that that is going to move your stock? And I think we had a range of people on there, people, I really, really value and like and respect that gave you those views. I mean, here we go. I mean, start with, where's the valuation? Is it cheap? You heard from Rupal about cheap valuations. We got a perception of cheap. Find out from David Marcus what is the value creation of the management? Are they any good? Some of these managers, they're just people at the end of the day. Have they got a track record of creating value? Find those companies. Find out about them. Look at the historical performance of their value. George Muzea, the insiders, how incentive they are, to pushing their stock price. You'll be surprised, if your incentives or your wealth is based on your stock price, you got a good incentive to move it higher. And then, even I talk about, the behavioral edge. Don't discount stuff like Gary when he says, decision making. And, I've been going on about analytical edge and behavior edge, and what the market thinks, what you think, your biases, the market's biases. All these things are rolled into your edge and what it is that you have beyond the market. And the last one with Joel, I mean, that's the classic. There it is right there. Look in places where other people aren't looking, and that's special situations, and that's spin-offs. And so all that stuff rolled in together is how you analyze a stock, basically, and that's it. So it takes a lot of work, but you get to there, you're doing much more than anybody else, and you'll win longer term that way. So and so, like I say, the question of on the climate and how the challenge of trust and all that sort of stuff and where we are, think of where we are in the cycle, think of the behavioral biases of the market where it is right now, and apply that to your investing. And if everyone's going the right way, one way, you probably want to go the other way. So so that's kind of the idea that I'd say. Again, look at my Forbes blog, you'll get a good idea of how I think. Check into us, we'll give you an idea of what's coming up in the special situations front. I hope you enjoyed today. Just to reiterate, we crossed our line of $15,000. We had our target. So thank you very, very much for that. And like I say, we just rely on people's generosity to do that. We rely on the speakers' generosity. Thank you to all those guys for giving up their time. Really appreciate it. We do this every year. We start on zero. We never know how it's going to pan out, but we are always dumbfounded by people's generosity for our calls. So thank you very much for that. I hope you enjoyed today. Let me know your thoughts. Send me an email, check in, and like I say, happy investing. Thank you very much.